Hit it. It's Friday, July 2nd, 2021, episode 138. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome to the show bond veteran Mike MacBain from East Coast Fund Management. We have a terrific discussion about credit spreads, how the industry has changed, and what the Fed is trying to accomplish with their recent shift. Then Morris is back, and even more Morris than usual. We are then followed with Patrick doing his technical analysis voodoo, trying his best Magic Mike impersonation and failing miserably.
And this week in trading history, we go back to the creation of Black-Scholes. We end with our segments of No Stupid Questions and Skin in the Game. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
This week, we're drinking Eagle Brewery's Banana Bread Beer.
Oh, no.
It's scary sounding. Let's see.
So let me read you a little message from the brewery. Long ago, ale was known as liquid bread. We've used our long history of creating the finest malt blends and added fair trade bananas to awaken the senses with a seriously fruity, rich, yet surprisingly versatile banana bread beer.
So I expected to hate it.
Oh my! Don't tell me.
I actually like it.
Like
it's.
Oh my God!
I
don't know why.
Bread when you open it.
It's good, and maybe it's because I like banana bread.
You know what? I love bananas, but I don't know if this is my beer at all. But anyway, it's a British beer too. We don't have
enough of them. We don't have enough
of them on the show, and that I guess this is representing now, right? Like we haven't had one in months, and then suddenly bring on banana bread.
Rolling his eyes, going her eyes. What the hell are you guys talking about? Okay, let me do our side effects or our disclaimers, but it's more appropriately labeled. Nothing in this podcast should be viewed as investment advice. The listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include index vertigo, tether tantrums, or gametal warts.
I've never had those before, though. All right.
Let's get on to our first guest. It's our pleasure to welcome to the show Mike MacBain. Mike is actually the CIO, CEO, and CIO of East Coast Fund Management. Thanks for coming on the show today, Mike.
It's my pleasure, Kevin.
I've kind of laughed about this and thought that I've been looking forward to chatting with you about this, and we are going to talk about some rather esoteric things like credit spreads and bonds and kind of fancy things like that. But before we start, I thought I'd tell a story of how I came to meet your fund. And it was way back when, a few years ago, that I wrote a piece talking about how credit spreads were tight and that there was all these Canadian funds out there that were making a kind of a business about what I thought was just kind of investing in levered credit spreads. And I wrote this piece saying that these levered credit spreads were a potential problem that might occur, and it ruffled a few feathers. And I thought what was interesting about it was that it ruffled a few feathers, but there was these people at East Coast Fund Management that reached out and said, "Listen, here's why you're wrong," and you proceeded to walk through and give me a great example and talk about the strategy. And not only that, say, we completely agree with you that spreads are tight, but this is how we're going to actually, navigate this. And I got to know you guys, and I was amazed because you were the ones that actually navigated that, unfolding credit widening event better than anyone else. So it's been a pleasure getting to know you guys since then.
Well, it was, I remember it well myself as well. And it was, you never like to have someone that's sort of marketing against you that has a pretty good following in the market. We were a bit perplexed as to how we were going to deal with that, and we thought the best way to do it was just to meet and chat about how what we did and what our views were, and in the end, I think we actually both got to pretty much the same place, I think.
I think we did. And not only that, you convinced me, and I've been a fan of your firm ever since. And I thought you handled it like grown-ups, and it was really terrific to see. So let's talk a little bit about yourself. You've been in the industry for a long time. Why don't you kind of give us a little snapshot of your career?
Sure. Well, at the risk of dating myself, I started back at CIBC in the mid-'80s. At that time, and I'll add a couple of funny stories here, but at that time, the investment bankers were kind of Oxford and Cambridge educated guys, and the traders were mostly, a grade 11 educated, learned most of their trading skills literally in the street markets in London. And I was a group of 50 graduates coming out of university, keeners that CIBC hired for literally no money.
Right.
And the pitch that they gave us was, look, in 6 months, we'll double your pay if you're still here. And in a year, we'll quadruple your pay if you're still here. But the likelihood is that only 20 of you will be here in 6 months, and maybe half a dozen of you will be here in a year's time. But, I think that's an interesting story, because I compare that to my last years at TD, where we were hiring about 5 graduates out of university into the trading room every year, and it would be almost unheard of for any of them to be fired.
It was definitely a little bit more of the strongest survive, and everyone else, the weak members of the herd, will be culled. So you were a young kid that had just graduated. I guess you went to school here in Canada.
I did, yeah. I went to McGill.
And then you picked up and went to London. What did your folks think about that? Like, were they excited about you heading off across the pond?
Well, I was born in Scotland, so
okay.
I moved to Canada when I was 5 or 6, and we moved to New Brunswick and lived there until I was 18. Then to McGill, and then off to London. So it wasn't that big a stretch. I mean, all of our family was in Scotland rather than down south, but it wasn't unfamiliar to us.
Okay, you must be upset about the soccer or the football game lately.
I don't even watch football. It's like being a Maple Leafs fan.
That's right.
If you're an English or a Scottish soccer fan.
Well, they have a good team this year, and I'm hoping they do better. So let's not cheer them. Okay, so you go to CIBC and you start on the trading desk. They put you right in there, and you're trading fixed income, or are you trading derivatives? Why don't you kind of just walk us through the ensuing couple of decades?
Yeah, well, this is kind of funny, and it's going to be a bit embarrassing, but I was lucky at CIBC. So shortly after I'd made the cut, a big box arrives through the internal mail from the head office. So it sat around in the office for about a week until the head trader kind of looks over at me and he yells, "Hey, Strapper, there's a computer in that box from head office. They want to start a derivatives business over here." And we got no idea how to figure out how a computer works. So if you can figure out how it works, you're our new derivative trader. And so literally that is how I became a derivatives guy back in 1986.
You were the head of derivatives.
I was effectively the head of derivatives because I could unpack a computer and plug it in the wall and download, MS-DOS, I guess, in those days, what it would have been. So there's high quality recruiting for you right there.
That's right. So you're a CIBC and at this point, and you're trading fixed income derivatives. And so walk us through, like, what does that look like? What do you like? How do you even go from just being this kid that that had been strapped into this kind of rocket ship of newfangled derivatives?
Yeah, well, really, nobody knew what derivatives were all about back then, and it was really about intermediating between two companies that wanted to do something and taking some massive spread out of the middle. I mean, that's how it started. Companies like Pan American Airways and TWA were on one side, and companies like IBM were on the other side, and the banks would sit in the middle offering to
this is the beginning of swaps, right? Is that what you're talking about?
Swaps, yeah.
Right. And so from there you kind of go and do you spend a lot of time at CIBC, or do you eventually move on?
I was there for 4 years. I really never looked back at that point. Like, I was one of, I got in 1986. I was amongst, a handful of people globally that really started in the derivatives business. And 4 years later, at the ripe old age of 25, Bank of America hired me as their youngest ever vice president to be head of fixed income and derivatives for what they called EMEA, which is Europe, Middle East, and Africa. And so here I am, 25. I'm kind of, running a pretty big, American banks, European derivatives business. And that was a massive, massive step for me. And then in my early 30s, it was time to come back to Canada, and I joined TD, where I worked there for, 12, 13 years. In the last sort of 5 or 6, I was president of TD Securities and retired, started East Coast.
And so when you're at TD, do you move away from the derivatives and go back to just cash trading, or do you walk us through kind of that period at TD?
At B of A, I was responsible for both the fixed income bond business and their fixed income derivatives business.
Right.
When I joined TD in 95, I guess, I was just responsible for their global interest rate or fixed income derivatives business for a couple of years, and then I was put in charge of Canadian fixed income as well. And then a couple of years later, I was put in charge of equity derivatives, and a couple of years after that, equities, and then a couple of years after that, they made me the president of the whole outfit. So
I didn't realize that you had us equity traders under you as well.
I did, yeah, for a very short period of time. That was my last 2 or 3 years. I think that was really when I became president of the cash equity business came out.
What was it like moving from kind of having another asset class under your belt? Did you find it was all the same? Traders are traders, instruments are instruments, or did you find there was a definite difference between equities and the bond guys?
Yeah, they're all. All the asset classes are slightly different. It's kind of weird because even the individuals that are in those businesses are slightly different. Their personalities are different. Bond guys tend to be perennial bears and pessimists and depressing all the time. And equity guys tend to be super happy, always excited, optimistic. And FX guys are just aggressive monsters, basically. so you get all these different personalities in one trading room, and it's crazy how different personalities kind of get attracted to different product sets.
They gravitate to the one that they were destined to be at.
Exactly.
I have a question for you. After having managed both equities and bond guys, you often hear that the bond guys are smarter than the equity guys. Can you confirm?
Yeah, smarter is a difficult word. So from an analytical standpoint, yes, I would say they're smarter. From an overall market standpoint and driving a business standpoint, I would say probably not as smart. The equity guys, they're in the control tower, right? They're making the decisions. Corporations are interested in what equities are doing. They don't really care much about bonds. So
I see.
So from a business standpoint, the equity guys have the upper hand, but from the intellect standpoint, in terms of the product and the analytics, I'd say bond guys are.
I always find the equity guys are much more dreamers. And as you say, the bond guys are all pessimists at heart.
Yeah.
Over those kind of 30 years or 20 years, 25 years on the sell side, what was the biggest change you noticed in terms of how business was run or how kind of the business that you started at 85 or 86 when you went to London versus the business that you left right before you went to start your hedge fund? What was the biggest change that you noticed during that period?
Well, there were two enormous changes in my career. One was when I was in London and the euro started. So it went from having different individual countries having their currencies to them all joining the exchange rate mechanism, and that created a whole bunch of friction and confusion and market tension and volatility that is unheard of today. Like interest rates. For a period of about 6 months, interest rates were moving around 4 or 5% every week.
Right.
So, think about how you run an economy in today's world when you talk about it moving interest rates 25 basis points, everybody's freaking out. Back in those days, 25 basis points, nobody would have even blinked an eye.
Right.
So that was one, and then when the credit derivatives market really started to build in the late 90s, and the innovation and just the new products coming out sort of week after week, month after month, which actually also spilled into other structured products. And having a derivatives bent myself, that was quite an exciting time for me to creating fixed income products that had derivative features to them that you really could add a lot of value to the market or create opportunities in the market. Unfortunately, as always happens in the financial markets, a good thing comes to an end because everybody gets involved and starts making it crazier and crazier and crazier and crazier until it explodes. And ultimately that's what happened. But that was a super fun time to be in the capital markets business, and really was the end of, what I felt was, because at that point it just turned, the sell side business just turned back into a relationship business, and that wasn't really what I was that interested in, and that's why I left in the end.
You mean after the great financial crisis and how when we had to make changes because Volcker rules and everything like that.
Right, exactly. And proprietary trading wasn't allowed, and a lot of new innovation was basically clamped down on, and so it just became not as fun.
Well, that's a great segue to what you have morphed into. So why don't you tell us about East Coast, what you did, and why you went and started it?
So, at East Coast, we're an alternative fixed income fund. It's really a strategy that we pioneered in our credit products group at TD, and really using fixed income products to create kind of a low vol equity return.
Right.
And really, although we use bonds, we're really just trying to arbitrage shapes of credit curves. We're trying to take advantage of aberrations in credit curves, aberrations in prices between capital structures, aberrations in prices between, the same credit between synthetic and synthetic meaning derivative or CDS and cash credit. And, we thought there was a good opportunity for that in the market when at that time. There's now a handful of people in the market in Canada that do similar things.
Right. So I'm going to interrupt here, Mike, because you talk about credit curves, and I know a lot of people will be like, credit curve, what's that? So let's start with a yield curve. Explain a yield curve, and then explain a credit curve so that people can understand the difference in what you're talking about.
Okay, so a yield curve is basically the borrowing curve in the yield curve in Canada. The Canadian government yield curve is basically the borrowing cost for the government of Canada across the yield curve. So, 1 year they might borrow 1 year money in the T-bill market at 30 basis points. They might borrow 2 year money in the government of Canada bond market at 50. They might borrow 10 years at 150. And so as you draw that curve between 30, 50, to 150, that's a yield curve.
Okay.
And so it's basically, that's what a yield curve is. So a credit curve is effectively the same thing for a company. So Rogers Communication, for example, would have a credit curve. And that credit curve would be basically where they borrow money at each of those time periods throughout time over the time horizon where they can borrow money. And let's use the same example. So let's say Rogers borrows 1 year money at 1%, 2 year money at 2%, and 10 year money at 3%. The difference between where they borrow their money on their curve, their funding curve, and where the government borrows its money on its yield curve, that's the credit curve.
Right. Okay. And so that's not for people to understand. It might be cheaper for Rogers to borrow at the short end. They might only pay a premium of 20 basis points at the short end, whereas the long end they might pay 200 basis points. And and the credit curve, it can vary depending on a lot of different factors. And so at this point, I just kind of wanted to highlight something that I found when I was researching my first original piece, which is John Huddle, which is a University of Toronto professor. And he wrote a piece, and we'll include it in the show notes. And he went through kind of historically the typical defaults based upon different ratings, and then how much the market paid for the different how much extra the market you could earn by investing in those different ratios. You want to just kind of are you familiar with that paper?
I am, yeah.
Yeah. So you want to just kind of briefly summarize his findings in terms of what he noticed, because I think this is crux to your argument about this arbitrage, is it not?
Yeah, I mean, we'll try and keep it at a high level.
Yeah.
At a high level, what he determined or what he surmised is that you get paid a higher amount of return for credits that have a very low probability of default, and the recovery upon default tends to be underestimated. And this is as a function of time as well. So the closer that the bonds are to maturity, they pay an enhanced return in relation to the amount of time left on the security.
Right.
And so at a high level, that's what he came up with.
So I have the table in front of me. So I'll just kind of briefly run through some numbers here. On AAA, he says that in real world, there's 4 basis points of default over a long period of time. Right. And yet the market, he says, is pricing it in as 67 basis points of default. Yeah. And then he goes through and all the way to like AA is at 6 versus 78, A's is 13 versus 128, and so on and so on. So although the market, prices in a higher yield in terms of as you go out the credit curve, you earn more. In terms of your actual risk, the risk versus reward, you're better off investing more at a higher level of credit. If I got that, would that be a fair assessment of it?
That's exactly what he came up with.
Right. So now, why don't you walk us through what that means in terms of how you use leverage in terms of applying that concept to your strategy?
Right. So, I mean, maybe it's a good time to turn to one of the slides that you have in the deck, just to help people walk through it. Yeah. So let's just focus on the right-hand side of this slide. So really, how it works as it relates to our strategies, what we're trying to do is we're trying to take a similar amount of credit duration exposure, credit duration being the measure upon which the price of your security or your portfolio goes up and down based on the amount of change in the yield of the bond. So, for example, if I had a 10-year credit duration exposure and yields went up by 10 basis points, I would lose 10 times 10 or 100 basis points or 1% in return. And so that's kind of the measure that bond guys use as a general measure to determine how much risk they have in their portfolio. So as a general guideline for us, we're looking to have a portfolio that has a similar amount of credit risk to that is in any one of your traditional Canadian index bond funds. Okay. So that would be, index duration is about 7.5 years. I've given an example here where we have 7.7 years of duration. But on the left-hand side of this page is an example where your passive index bond fund would go and buy a 10-year bond. Okay. The blue line is the credit curve on both graphs. So at that 10-year point, if I follow the orange line down to the x-axis, that gives you credit duration exposure of 8.5 years. That's the risk that you're taking in buying that bond, because again, if yields go up by 10 basis points or prices go down the equivalent of 10 basis points in yield, you're going to lose 85 basis points in terms of return. That's the risk you're taking. If you follow that over the y-axis, the return you're getting for that is 130 basis points for that credit risk. You're also getting this tiny little piece, and this is kind of, in my mind, the real rub about what Hull and White we're looking at is this kind of security appreciation that people don't really think they get on a bond, but they actually get it because as you move forward in time, the yield actually drops. And when the yield drops, the price must rise. So that's this tiny little piece of security appreciation of 36 basis points. So the total return that a passive bond fund gets for taking 10 years of corporate bond risk or 8.5 years worth of credit duration risk is 166 basis points. Okay. Now, what Hull and White figured out is that, okay, you can position yourself and get paid a lot better than that. And you can get that by positioning yourself on a steeper part of the credit curve. Okay. And so that's that in the example of what we do on the right in this illustration is at the 2-year bond point. Right.
I just want to interrupt here and say that the credit curve has to go to zero at maturity. It comes in as they pay the bond, it goes to zero. So the steepness of that curve is and we'll talk about this in the future, but in Canada it's particularly steep, meaning that it's high, and then it kind of falls off really hard in the last few years.
Yeah, we can talk about why that is later, right. But yeah, so you have this kind of steep part of the credit curve, and you see that creates this green triangle, quite a large green triangle of profitability for you. So, if you just bought 1 2-year bond, you'd get 50 basis points of return just from falling down that credit curve. You'd also get 70 basis points of coupon yield. The difference is you're only taking 2 years of duration risk. So on a standalone basis, I buy a 2-year bond, I earn 118 basis points of return. I take 2 years of duration risk, or slightly less than 2 years of credit duration risk, versus the passive bond fund that's taking 8.5 years of credit duration risk and earn 166 basis points. So now I want to take a similar amount of risk to what the passive bond fund is taking. So instead of buying 1 2-year bond, I buy 4. So now I have about 7.7 years of duration exposure. So if the 2-year bonds that I own go up in yield by 10 basis points, I lose 10 times 7.7 or 77 basis points, which is similar to what the traditional bond fund would lose if yields went up by 10 basis points at the 10-year point. The difference for me, though, is I get to earn 4 times that 70 basis point coupon, and I get to earn 4 times the security appreciation as well. And so that leaves me with a static return in this illustration of almost 5%, or versus theirs of 1.75%. And so that is a meaningful enhancement to the return profile in a product where, really at the end of the day, you're now long 4 2-year bonds. And the reality in the investment grade bond space is that default is a very, very low likelihood. And even if it does become a potentially higher likelihood, you're much better off owning a bond that matures in 2 years than you are owning one that matures in 10.
Right. And so when a lot of people think about a traditional credit fund, I guess when these things first started, people used to go and just try to get the most juice they could in terms of going out the longer dated securities because the spread would be higher in absolute terms. And this is kind of flipping that on its head, saying, no, you're better off going and doing more of a short dated one.
Yeah, it's certainly that. The reason this is difficult is because it's not easy to, there's a lot of stuff going on behind the scenes to allow you to do it, right? So you can't just go out and, call up your broker and say, I've got $1, I want to go and buy 4.
Right, because your funding is important.
Bonds.
You fund a lot different than I do.
Yeah, because if you paid full funding costs in order to do it, then it would negate all the returns that you're going to get to begin with. So you have to be able to do it in a way that you're lending the securities that you own and you're borrowing the securities that you're short, and your net funding cost is just the bid offer cost between the two, as opposed to the full margin loan cost.
Okay, that's the first thing. And then you also have to be able to go trade these things, which is more of an institutional market. Obviously, most people can't do it. Let's just talk a little bit about, you mentioned that you used to do this at the bank. And so was this a strategy that was employed, that previously the banks were almost doing shadow funding and doing this across the board?
I don't think so. We did it pretty actively at TD. We had a proprietary credit business as TD, alongside of our sort of capital markets credit business. All of the Canadian dealers would have had your traditional capital markets credit business that is just there to facilitate client flow and to facilitate new issue business coming and going. But we felt that we could make, a pretty meaningful return overall for the bank, given the capital that we were using. And it turned out to be one of the most profitable businesses that we had in the firm for a while, because bank capital is different than our capital. So, if for you and I, it's a decent return for us, but bank capital treatment at the time for these products was about 20% of what you and I would view the capital at. So they were getting 5 times the return in terms of return on capital out of this product than we're getting, and our target return is 6 to 8%. So if the bank's getting sort of 30 to 40%. Return on capital from the business. So it was something that they were quite fond of at the time.
So we mentioned the fact that Canadian credit curves are steeper than American curves. can you touch on that, and then also talk about how the kind of your equivalent, what your kind of I guess competitor in the U.S. is doing in terms of how they are playing their curve and what their credit funds would look like?
Yeah, so the Canadian space is very unique in that, we have three areas in the fixed income market that have a very high demand for bonds. And we have, one, well, not one particular maturity, but one segment of the credit curve where there's a very high supply. So the high areas of demand are 15 months and in, which is for money market products. So there's a lot of money that's just sitting in money market funds that can only purchase money market securities with mature within the next 15 months. So that's generally pretty expensive, and credit spreads in that product approach zero pretty quickly. Then you have your traditional index fund market. So that would be, every bank asset manager would have an index, Canadian corporate bond index product. And that basically just follows the index. And they're primarily buying bonds between sort of 6 and 10 years of maturity. And then beyond 12 years in Canada, we've got one of the most developed asset and liability management sort of platforms or strategies for our financials, for our insurance and pension fund community. So basically every bond beyond 12 years is being purchased for asset and liability management purposes, but for those long-term investors. And so what happens, what you see then is you get, very low yields at the money market point. You get relatively low yields at the sort of 6 to 10 year point, and you get basically flat and even inverted credit yields once you get out into 20 and 30 years. And then you have this weird scenario where Canada is one of the few countries in the world that has limits on the amount of funding, wholesale funding, that the banks can use to fund themselves. And so because they need to get so much of their funding from retail sources, from a regulatory compliance standpoint, they have to go out into the market to entice people to give them retail money. So they do that by, the dollars that everybody puts in their savings accounts. And they also do it, the main way that they do it is through GICs. Okay. And so the GIC program is, they issue GICs in 1 year through 5 year maturities. And they're AAA government guaranteed, bank certificates. And they generally come, depending on the market environment, but they generally come at a spread of somewhere between sort of 15 basis points on the short end up to, even as high as almost 75 to 100 basis points in 5 years. And so that creates a steepness of the credit curve for a AAA borrower, because these are government guaranteed and Canadian government is AAA rated. So any other borrower that wants to borrow money in that sector, meaning 1 to 5 years, they have to borrow as a spread, basically a spread to the Canadian GIC spread.
Okay.
And so that effectively enhances or pushes up the absolute level of spread for all investment grade borrowers in Canada between 1 and 5 years, or really between 2 and 5 years, because that money market thing, GICs and money market don't pay much, and the money market sector don't pay much. And that creates that, nice steepness and that opportunity in the Canadian bond market that really, we've looked and scoured the globe for other opportunities. It doesn't really exist anywhere else.
Oh, I didn't realize that. So we are very unique. So what does your competitor in the U.S. that's running a credit fund, they just don't have this advantage, and they're just, picking off the credits that they think are kind of good value and trying to isolate that element without this kind of, let's just say, positive carry from the credit steepness?
Yeah. This structural benefit doesn't really exist anywhere else. Like in the U.S., you'll see most of the big U.S. credit funds are they have a mortgage market that basically just outshines every other mortgage market in the world. Outshone it in a bad way in the crisis, but it's just so deep with so many different types of mortgages in it. Most of the credit activity in the U.S. or not, I should say most, but they got a big corporate market too. But the big difference for U.S. credit firms is the structured credit and mortgage credit.
Right. So now you kind of briefly touched on the great financial crisis, but we've also gone through recently the COVID crisis. So why don't you talk to us about what happened during that period, how it manifested itself, what occurred to funds using credit, like just kind of some color would be appreciated.
Yeah, it was quite a time.
Yeah.
It was the worst of times and best of times all kind of at the same time. Because I mean, for an investment grade, levered or moderately levered fund, it was tricky because the whole premise or the foundation of that crisis from a financial asset standpoint was created by the banks. So the banks all have committed lending facilities out to the majority of their investment grade borrowers. So what I mean by that is that investment grade companies, they sign a 1-year deal where they have a commitment from their banks to on any day at the drop of a dime or at the receipt of an email that they can borrow up to some number of dollars at some rate.
Right.
And that borrowing, that is called a committed line of credit, is good for a year. And so basically what happened when it was apparent that COVID was coming to North America or the Western world, many of the investment grade borrowers just said, okay, I don't know what's going on here, but what I do know is times like this is I need money. And so I'm going to tap my committed line of credit. So across North America, there was about $1 trillion of credit lines that were tapped. And the banks were legally obligated to fund those within 2 days.
Okay.
And so over the space of about 10 days, the global banks had to come up with $1 trillion of money. Now, that's not a problem if they've got 3 months or 4 months or 2 months to plan as to how they're going to raise that money. But to do it in a week is impossible. So bank funding spreads and sorry, let me step back. And because this was a phenomenon that wasn't going to be long standing, meaning that the commitments were only out for a year anyway, most of the banks said, okay, well, I'm going to borrow this money for the lowest possible period because it's costing me a lot of money to do it. And so they went into the short dated market and they started with 1 week and then 1 month and 2 months and 3 months. And so they were paying 200 to 350 basis points over their general funding cost to raise this money.
Okay.
So that started the liquidity crisis, if you like. So banks are paying 250 to 300 basis points over. That means that every bond in that space, all bonds are selling off because it's just kind of a contagion effect.
Right.
But in the short end, you can see exactly why it's selling off because banks are borrowing money at 300 basis points higher. So that means Rogers Communications probably got to borrow it at 400 higher, and so on and so forth. And so for us, being a short dated fund, which is levered, that was very challenging. And then you got the scenario where daily liquidity mutual funds had redemptions and they were forced to redeem, and they're forced to sell product into a market that couldn't absorb it. Now, that was the bad news. The good news is twofold. One, from a macro standpoint, is just a liquidity crisis. So the central banking system around the world is set up to deal with liquidity crisis, and they were pretty quick at dealing with it. And I would say within 3 weeks, the banking liquidity crisis was over. It probably took another 2 or 3 months for that to feed through into all the other borrowers and into the market, but it really didn't take very long. So that was the best of times comment. And from the standpoint of our portfolio, we took a major loss at that point in time, but we were in 18-month bonds, and within 6 months, the risk of my portfolio had deteriorated or had rolled off sort of 35%. The return that I had lost had all come back, plus the additional return that I'd received because of the enhanced coupon on reinvestment. And so it didn't really matter that the equity market came back. we felt really good about the fact that the fund had that kind of circuit breaker because we own bonds that none of them were going to default and they're all going to mature really quickly.
Right. And so now you were around, obviously, during the great financial crisis, and you mentioned that this was a liquidity crisis. Do you think that differed tremendously from the 2008 crisis? Was that more of a solvency crisis?
Yeah, the 2008 was absolutely a solvency crisis. So they were different. They were very different problems. And this one happened. The size and severity of this, in terms of the money that was needed and the pace at which it was needed, was much faster than the financial crisis. The financial crisis was a market-based liquidity disruption. So, when companies started to default, everybody started to panic and started to sell stuff. This was a function of banks needed to raise money. And so that's what central banks are for, to provide liquidity to banks that need to raise money. So they're very different scenarios, and the great financial crisis is one that is much more difficult to repair. Thank goodness, in hindsight, people have different opinions of this, but they let Sachs and Lehman go down. Thank goodness they didn't let, another big bank go down, like Morgan Stanley. Morgan Stanley and Goldman Sachs were basically bankrupt too. Had they let them go down, that would have been quite a...
You think it would have cascaded and it would have been tough to...
Yeah.
Oh, okay. So they were correct to stop that, in your opinion?
I think they were, yeah.
And do you think that they were incorrect to let Lehman go? Do you think that they should have been more aggressive with that?
Yeah, I don't see why they would. It doesn't seem fair to me to save Morgan Stanley and Goldman Sachs and let Lehman go, to be honest.
During this COVID crisis, the QE numbers were just, mind-boggling to me.
Yeah.
Did you feel the same way? And do you feel like they've done almost too much now?
I do. Yeah, I really do. Canada has figured out that I think they might have missed a zero or two when they put their plan into place.
You mean, or added a zero or two?
Added a zero or two, yeah. I think they realize, this is actually way too big. We're not going to have any bonds left if we keep it up at this rate. I do think the QE programs are too big. I also think the fiscal expenditure is too big as well. And I'm beginning to worry about the potential, what's the solution? There's lots of people that you talk to all of them, I'm sure, but there's lots of people that think, and I kind of agree with it, that inflation is the only way out of this.
Right.
And that's what everyone's trying to create. Okay. Not runaway inflation, but, kind of sustainable, higher than normal inflation, because debt levels are just too high, and that's the problem with where we are now.
So why don't you walk us through why what signs you see that you kind of concern you about the QE still being too large now, and you mentioned fiscal. Why? What are you seeing that worries you?
Well, you're getting a number of just signs of the plumbing not working. So back in 2019, we had the repo problem, right? Where repo rates spiked because there wasn't enough funding to finance the treasury balance sheet. So that was one example of a plumbing problem, and the Fed fixed that. And more recently, we've had the opposite plumbing problem, or the reverse repo problem, where there's too much cash in the system, and so banks are trying to figure out what to do with that cash, and so they're just lending it in the market at negative T-bill rates. Right. And so obviously the Fed doesn't want T-bill rates to be negative, or they'd take their rates negative. They would want to have positive numbers. So they've had to come out and raise rates on reserves to solve that problem. And I just think that each of these kind of nicks and plumbing problems and complications just makes the whole system more complicated.
And so what do you do from your perspective in running a fund to protect yourself against these increasing signs of things not working quite as well as they have in the past?
Well, it's actually, when you said earlier on that bond guys are smarter than equity guys, it's not that they're smarter than equity guys. It's just that it's obvious what you're supposed to do. So, and this is going to sound stupid, but when 5-year bank credit return gives you a return of 40 basis points, that's not much of a return.
Right.
So don't buy it. When it gives you a return of 300 basis points, that's a great return. So buy it. So when you get into these periods where, credit returns are really low, you find that the general market is extending duration. They're going down in credit quality because they're trying to earn a higher return.
Right.
It's exactly the opposite of what you should be doing. You should be reducing duration, increasing credit quality, and trying to do it in a way that you can still manage to make a return. And so that's the obvious to me. So things that we're doing, there's all kinds of, when you get to market, like transitions, on both sides, when things are expensive and when things are cheap, there's different things that pop up. Like, for example, you can buy 1-year Ford paper in Canada at a spread of roughly 200. And you can sell 10-year Ford paper in the US at roughly 200. So what are you going to do?
Yeah.
You're going to do that trade all day long. And when credit spreads widen, you're going to earn 10 times as much money on your short position than you're going to lose on your long position. And so there's example after example of situations like that, both between credit derivative markets and cash markets, between Canadian bond markets and US bond markets. And those are the crazy things that show up because there's way too much money in the system, and the things that are not on everybody's radar screen just are priced very differently than the stuff that's on everybody's radar screen.
And meaning that they're not on everyone's radar screen because there's some bond that's just doesn't trade very often off to the side.
Yeah, it doesn't trade very often, or it's in Canada as opposed to being in the US. Ford's a perfect example. It's as liquid as you like in the US. It's hard to trade a Ford bond in Canada. And so there's obviously a liquidity premium there, but you just see these different opportunities. And to be honest, the U.S. market is just on fuego. Like it's gone nuts in comparison to every other market.
In terms of credit being expensive.
Yeah.
And I guess that's one thing that differentiates you guys from, like, you're a credit fund and you would think that you're always long credit, but you can actually find ways to be strategically almost short, right?
Yeah, indeed. You certainly can. And rarely would we be, if you came to look at our positions, would you ever say that we're short?
Right.
But, for example, right now, we're probably less levered than we've ever been. Our duration is probably the lowest. It's sitting around 5. But it's trading because of the transactions that I just talked to you about. It trades like a duration of about 2.
Right.
So it's really, really low risk. And, our expectation is that we get into Q3, Q4, we find that inflation is either not as transitory as everybody thinks, or the disconnect between what the Fed thinks is inflationary and what the market thinks is transitory, and what the market thinks is transitory comes more into line, because I think the Fed thinks inflation transitory means 2 or 3 years from now, where the market thinks the end of this year.
Okay, so let's talk a little bit about that. You've watched a lot of Feds. You've watched a lot of different market cycles. Do you think that this Powell's new Fed and his new flexible average inflation targeting is indeed different? And when he made kind of this hawkish shift lately, did he really make the hawkish shift, or did he just kind of throw Stan and the rest of the, kind of those beating their drum, saying that they need to get more hawkish? Did you just throw them a bone?
I think that was done on purpose, just to contain the rise in longer yields.
You think that they were, by getting more hawkish, they could cause long rates to go down because it would show more of a kind of, let's say, concern about not letting inflation get out of control?
That's right.
Oh, so you think the Fed is that sophisticated that they're thinking that much, like that they're kind of thinking that far ahead?
I do.
Really?
Yeah.
What gives you that kind of belief?
I just think that I just believe that that's what they're trying to do right now. They don't want to raise rates. They don't want interest rates rising. They want to keep real rates negative, as negative as they can.
Right.
I believe that they think that controlled inflation is the only way out of this.
Okay.
Quite frankly, it's the only way out without a really nasty solution, in my opinion. And I think they realize that. And that it doesn't help them if 10-year rates get up to 2.25, and the equity market's down 20%. They need the equity market to keep kind of chugging along here. They don't need it to be ripping, but they can't have it down 10 or 15 or 20%. So that's why they. So
you think they're worried about the long end getting out of control, causing steepness, and you think that we were at the point where let's say the backup in the long end, the rising of yields at the far end of the curve was actually going to maybe potentially affect the stock market?
I do.
Really? Oh, I didn't realize that that's what it is. And so in terms of, so they made this shift and it was designed to keep interest rates lower in terms of the long end. How long before the market figures out that maybe that this wasn't, they're not as hawkish as they think and that they're not going to raise rates?
I think they can buy 6 months.
Okay.
I think that it'll take a while before real inflation does start to show up. I don't think there's a chance in hell he's raising rates.
Okay, so
right?
So why don't you walk us through? I love your opinion about. I agree with you that he's not raising rates. He just can't afford to, and eventually we're going to get inflation, or potentially, I shouldn't say that. There's those people who think that we're going to have all sorts of deflation and stuff. But let's say we did get the inflation that you and I think is coming. How does the market react, and what are the concerns and things you'd be looking for at that point?
Well, I think that the market, the reason why he did what he did is because he wants to tell the market that he's on top of it.
Okay, yeah,
right. And in doing that, he's creating. Yes, the curve shifted a lot, and yes, I'm sure lots of people lost lots of money in the rate market, but he didn't care about the rate market. He cares about the equity market. So at the end of the day, he's managed to control the big driver of risk in the market. And remember, financial conditions to him, tightening of financial conditions means higher rates, lower equity prices, and wider credit spreads. Okay, those are the three things. The things that impact it the most are the risk factors: higher credit spreads and higher equity prices or lower equity prices. So he's doing everything he can, in my mind, to control that. At the same time, he wants to keep real rates negative because he's got a massive debt problem and he needs to continue to fund it. So those are, to me, those are the things that he's doing to try and control where markets are going. And he can do that. I think he can do that right now because he's got this sort of 6 to 9 month window of transitory inflation that everybody's okay with.
Okay.
But come, end of Q3, middle of Q4, end of Q4, into Q1 next year, if we're still seeing inflation numbers like we're seeing, he's going to lose that. He's going to lose that window.
Okay, and then
he's going to be in another spot.
Okay, so let's talk about that spot because I'm dying to know how that plays out.
Well, I mean, it's impossible to know how it plays out.
But what's your guess? What's your guess? You've seen a lot of markets.
You look at what the Fed's done, right? They're just constantly kicking the can down the road, right? So they're not trying to upset any apple cart. They're just trying to keep it all going as best they can to get to the next junction. So he wants to keep policy stimulative. He doesn't want the equity market to fall over, and he wants to keep long rates or boring rates, which in the U.S. is frankly long rates, as low as he can.
Right.
And so I just think he's managed to do that for another 3 to 6 months. When inflation shows up again, he's going to have to do something different. So my guess is he'll start to taper. Okay. So when he starts to taper, the market will take that as a sign of, some of liquidity coming out of the system. It might be tightening of financial conditions, but it'll certainly be liquidity out of the system. Likely credit spreads will not love that. Okay. I would guess, to be honest, that interest rates will probably be contained as they do that. But I think after we've done that for 3 or 4 months, I don't think the market can handle it.
Okay.
I think the market will fall over.
And so the fact that you said he's not going to taper for 9 months, or at least 6, You means that you think that we're not going to get a Jackson Hole where he comes out and says we're starting kind of September.
No, I think you'll get a Jackson Hole saying we'll start, January, February, March, April time.
Oh, okay.
I don't think it really matters, to be honest. Whether it happens in October or in February, just change the time frame as to how it impacts the market in my mind.
Okay. And so then ultimately, do you think that the real risk going forward, kind of the bigger, longer term macro risk, is that we have higher interest rates because inflation does run 3-4% on a sustained basis?
Yeah, I think it's how he deals with that. So he's gonna have a problem where I think we're gonna see this inflation. Is he going to try and fight it? If he tries to fight it, I don't think the market can handle it, and I think you're going to get another risk off event, because in fighting that, he's going to have to. I don't think he's going to raise rates, but he's going to have to taper. He's going to have to take liquidity out of the system. The market, I don't believe, can handle meaningful liquidity coming out of the system. It's just too expensive.
Right. And then from your perspective, this is kind of the quicker that he gets to that situation where he causes credit spreads to widen, the better off you are, because in the meantime, credit spreads are too tight almost for you to make any like that to really get the positive returns.
Yeah. So right now, I've been telling my clients to expect, numbers in around, 5% for this year. And, it's kind of boring, and it's been kind of 25 to 45 basis points a month. And that's kind of where we're at. And we're just sitting here trying to continue to do that in the expectation that we're going to get a credit spread widening. And the good news for us is that rates have been rising for the most part this year. And most fixed income funds are in the red.
Right.
So, the spread between what we're producing this year, and the spread between what we produced last year and what fixed income funds was produced was kind of 3-4%. And the spread this year is also 3-4%. So we've been able to continue to outperform that segment.
That's terrific. Okay, so let's just follow up and finish up here with our 3 questions. And I've given you some time to think about them, so I'm hoping you have some good answers. Let's start with your favorite investment book.
Psychology and Money is my favorite investment book by a mile.
Tell us why.
Well, trading's all about fear and greed. So how do you manage those emotions under stress? How do you deal with that? And, that's really, at the end of the day, we've all had that scenario where markets are going up and you got this voice in the back of your head kicking yourself saying, God, I don't own enough. And markets are going down. You're like, God, I'm too long. And so that's just, to me, that this book delves into that subject pretty well.
So this is Morgan Housel, right? Or I don't know if I'm saying that correct. It's actually a relatively new book. So it's replaced your, what was your favorite book before that?
I got a bunch. Reminiscence of a Stock Operator would be my, historically favorite book.
Even from a bond guy?
Yeah. It's a good book. When Genius Failed, a good book. Liar's Poker, I love just because that was kind of when I was, making my way in the market.
Right. Sorry, I didn't mean to interrupt, but when Genius Failed, do you have any good long-term capital stories for us that you can share?
I don't really.
It's been a long time. You can talk about your clients now. Okay, no, I completely understand that.
Just that I was very good friends with a bunch of guys that worked at Solomon Brothers when I was in London who knew the guys, the guys that ran long-term capital.
Okay.
And they said that those guys just thought their shit didn't stink. And they were all so happy when they blew up.
Okay, the next question. Are great traders or portfolio managers, are they born or made?
So I would say both. When I was at TD and Bank of America at the executive level, the HR departments all do psychological profiling on their executive teams.
Okay.
And so having been through that process a million times, the 2 characteristics that every successful executive has, one is the natural ability or desire to take on risk, and the other is resilience. So the ability to keep moving forward when, everything looks bleak. And so I would say, especially the resilience character trait, that is one, well, both actually are traits that that very much show up or need to be there for someone that's going to be a good portfolio manager or a good trader. Like at the end of the day, if you're right 55% of the time, the day after you've done a trade, you're a genius. So dealing with being wrong 45% of the time is tough.
Right.
And so if you don't take judgment or, failure or being wrong pretty nonchalantly, it's going to be a difficult career for you. So in that regard, I would say that you got to have that character trait where you like to step up and take risk. And I think that's one of the reasons you find that, competitive athletes have found their way into a lot of C-suites and into a lot of trading roles, just because they're used to being kicked and knocked down and getting back up again.
Right. But
obviously there's a ton of experience that's involved in trading. And I do think that some of it can be learned.
You must have been in charge of a lot of traders over your years.
I was.
Did you find that you as an individual could help them along or putting them together with others, or was it more of a just kind of sink or swim kind of mentality that seemed to, there was not much you could do to help them?
Again, I'd say both.
Okay.
Like the guys that were just naturally good traders were so frustrating because they couldn't help anybody. They didn't know why they were doing what they were doing. They were just doing it and they were making money at it, and they could never explain it. The guys that were more learned in it, they could help people and train them and bring them along and get them to look at signals and build models and stuff like that. But actually, to be honest, the best guys were the guys that, if you walked up to them and they were long and you asked them why they were long, and they couldn't really tell you because there's more buyers than sellers, would be the normal answer. And, dollars to donuts, they'd make money. They were impossible to manage.
Okay, the final question for you. If you had a young person come to you today and say, I'm really interested in this business, I'd love to get into it, what advice would you give him or her?
It's just the same advice I've given young people since back in the mid-90s. Like, choose a profession you love, work harder than anybody else, and you'll be successful. So, trading, investing, portfolio management, whatever you want to call it, it's got to be the most competitive business on the planet. So the only way you're going to be super successful is by outworking everybody else, and be that with a new idea, a new strategy, a new market, a new technology, a new program. The bottom line to me is if you don't love it, you're not going to work hard enough.
Right.
So whatever profession you choose, you're going to spend a lifetime doing it. So if you don't love it, you're going to be unhappy and you're going to be pretty average at it. So that's the key to me.
So speaking of stuff you love, I almost went this whole interview and I promised myself I was going to ask you about it, and I just clicked on me. So thank God I remembered. As a Canadian that is suffering through winters, and you as a Scot that has moved to Canada and then moved back to England and then back to Canada, you have obviously suffered through some terrible weather. You've recently relocated, and why don't you tell people where you are, and why don't you say, I'd love just to get your impressions of how that has been, and let me know if I should be coming with you, like, the next winter here in Canada.
Well, we moved our investment team to the Cayman Islands in, I'm going to say, the end of 2019.
Okay.
And the only regret that I have is that I didn't do it 10 years earlier. It's been great for our team. It's been all great for all of our families. It's been great for our business. And the real genesis of why we did it is, as you can tell from the conversation that we've had so far, I'm not young. And, I really enjoy the business that we're doing, and I really enjoy being in the markets all the time. And I want to do it for another 15 or 20 years, but I don't think we all, we got together, we got a couple other old partners as well. And we got together and we said, look, like, if we want to do this together as a team in the same location, we're just not going to have the longevity to be able to do it, just because we can't suffer out those winters. They get harder and harder. They get harder and harder every year.
Yeah.
And so that was the starting point as to why we decided to do it.
Yeah.
Now, the Cayman Islands was why we decided to get somewhere warmer.
Yeah.
Cayman Islands was the natural place to do it because our fund was based there and domiciled in the Cayman Islands anyway for investment reasons, and it's worked out great. Now, I wouldn't say everything's awesome about it. Like, it's a small place. COVID, although they've done a great job of eradicating it in the Cayman, and we haven't had a community case since April of 2020. None of our kids are wearing masks. Everything's normal. Everyone's playing sports. There hasn't been a lockdown since May of 2020, and that's been great. But we've been on a desert island for 15 months.
That's right.
So
you're not allowed to leave, right?
You're not allowed to leave.
Well, if you come back, you get the thing around your ankle, like you're a convict.
Yeah. Yeah, you get your 14-day quarantine, and you got a bio tag associated with it. They're really serious about it, which is great. Yeah. But yeah, it's a place that you want to be able to leave every now and then as well.
Right. So you are getting a little of the island fever.
Definitely getting a little island fever.
Well, you know what? You're getting a little island fever, but I'm sure that if you get allowed back on and then you're come to Canada in, like, let's say January, you'll be like, oh, I'm going right back. The island fever will disappear. Well, there's nothing will cure that better than a little bit of, having to visit a client in Winnipeg or Toronto in January. I can say that. I'm from Winnipeg. For sure. Listen, Mike, it's been a pleasure having you on. Why don't you tell people about where they can find out more about your fund and reach out, and if they have any questions or are interested in, kind of investing with you, where they should contact you?
Well, they can just reach out to us at info@ecfmi.com. Somebody will respond to whatever requests that you have. I certainly wasn't, planning on, having thrown out, requests for interest or anything like that on this call. It's just been a pleasure to chat with you, and we haven't chatted in a while, and it's always fun.
It's a pleasure having you on the show. It's great getting caught up with you. It's been a long time since as you've taken off to warmer climates, and I must say that I am jealous. I look forward to, when the COVID's gone, and either I can come to visit you in Cayman Island, or you can come visit me here, getting together for a beer.
Yeah, that would be awesome.
Thanks a lot. Thanks again, Mike. It's our pleasure to welcome to the show fan favorite, Morris Sachs. Morris, how you been doing?
Oh, I'm doing good, Kevin. How are you today?
Oh, I'm good, thanks. You, Patrick actually had, what was it, This Week in Trading History, and he talked about Salmon Brothers.
Oh, yeah.
That's right. And you reached out and you said, listen, if Patrick wants to learn about Salmon Brothers, I got some stories to tell you, and it's not going to be from the history books.
Yeah. So Patrick, you were talking about the 2-year note squeeze?
Yeah.
And just to walk me in, can you give me a little recollection of what you were talking about?
Oh my goodness!
Oh, Patrick won't remember either. I'll help him out. It was the fellow under Tom Strauss that went and basically put into the auction for more than the total auction, right? Like, I think they bid for more than 100% of the auction. Yeah. Ended up taking down the whole auction, pretending it was what PIMCO.
Yeah, I think it was like 90% of the auction.
Yeah, they took down 90%, right? Because there's the indirect or whatever it is that gets it no matter what. They took it down, pretended one of the clients bought it, and then when the client ended up kind of decaying the trade, they got caught.
Yes. Okay. So let me jump in here. So the pecking order went John Goodfriend, then Tom Strauss,
right,
then John Merriweather, then Paul Mosier.
That's right. Now, we said it wrong, which is
not
unusual. Yeah. Not unusual for Patrick.
Excellent.
He gets about 2/3, maybe 3/4 of them wrong. So,
yeah. Well, you guys say words differently. Like
that's right. A boot and the Z. You know what? That's what the problem was. It was the Z.
That's exactly it.
Mosier spelled with an S, but anyway.
Oh, is it? I thought it was spelled with a Z. Okay.
Well, I don't know. We can go check his criminal record. Find out. So okay. So this had to be in like the April, May, June timeframe. I'm guessing it was maybe 1991-ish.
Sounds good. Yeah.
Okay. So at that point, Solly was sort of at the pinnacle of the Treasury bond market. They were the end all and be all. And
they were the Goldman Sachs of that era. Everyone wanted to work there. They were the ones doing all the proprietary trading. It was the place to be.
Yep. Right. So when the guys I knew there who were like Craig Coates, Craig Coates ran the desk.
Okay.
And Neil DeBrow was the 2-year note trader. Tom Murphy was the 10-year trader. And Joel Casas was the bond trader. These were the guys sort of in my era. Not that I was at their level of seniority, but, I was younger, but I got to know them a little bit.
Okay.
So Coates and a bunch of guys left to start their own firm. And I think how it went was Merriweather, who was running the prop group, got charge of the Treasury group, and he put his guy Mosier in charge of it. Now, this is from sources believed to be reliable but not guaranteed. You've read the book Liar's Poker, right?
Of course, one of the greatest trading books ever written.
Well, there were rumors that one of the guys cheated.
What do you mean?
Like, you know how you play Liar's Poker? It's like you look at the numbers on your hand. And
cheated at the game?
At the game, yeah.
Oh, I take it you're not going to tell us which guy it was.
Well, past performance is not guarantee of future results.
So how did he
that's
cheat?
How
he kind of reached, or he had bills in his pocket that he carried around?
It's an honor game.
Yeah.
So
I see.
You would just say, like, instead of saying 3 twos, it's like, I had 5 twos.
Ah.
But that's not why you wanted to talk, right? So
no, that's a good story. I like that. So there was one guy that is rumored to have cheated in the infamous Liar's Poker.
Oh yeah, and I heard it from 3 or 4 people.
Oh gosh. Well, listen, someday when we're out drinking, you're going to have to tell me who it was.
You got it, buddy.
Okay.
So the way this 2-year note thing went was, when you're doing arbitrage, so $1 million of a 2-year note at this point was only worth about 15 cents of a 30-year bond.
Right.
Put another way, maybe you needed 6 million 2-year notes for 1 million long bond. Right. And so these guys were doing these massive arbitrages.
Okay.
And so they could take a couple of billion 2 years and bang out, a couple 100 million long bonds.
Right.
And have, interest rate neutral risk. They would have big curve exposure.
Right.
And so what happened was, I hope I get this right, but I will in general terms. So the April 2-year note got to be pretty expensive and pretty tight. When I say tight, it means that they were tough to borrow. The borrowing rate was very low. And when somebody's short, it has to pay a lower borrowing rate. It's more expensive. So for a relative value guy, that's tough. And so one of and I suspect this is what the Solly guys did, because it was a little bit of a textbook approach where you would make something sort of tight.
Okay.
Like you would do to the April.
Yeah.
And then you would kind of make the next issue, the May, look not so bad.
Right.
So you get all these guys in the April thinking, I'm just going to move my short to the Mays.
Yeah.
And you make them feel comfortable. They get very casual. And then you get out the big net.
Turn the squeeze. You turn the screws.
You turn the squeeze, yeah. So there's the general story of they accumulated more than existed.
Right. Okay.
And then what they did was they put bids in for clients, because you could buy up to, I want to say like 35% of the issue in-house.
Yeah.
But you could have an unlimited amount of clients.
Right. So you could still bid for 200% of the issue for 5 different clients or whatever the math is.
And that's what they did. And eventually the Fed started calling around and checking the bids against the bid form in the client name versus the settlement and stuff like this.
Yeah.
And, they would do that as sort of an audit, but it wasn't necessarily, guaranteed you were going to get caught.
Okay.
And I think what happened was there was some delivery and the client didn't know the trade, and then it kind of went, into the out trade area.
Right.
And all of a sudden people are like, wait a minute, these guys didn't bid for these things.
Yeah.
Oh, wait a minute, we bid for too many.
Yeah.
And then, the gig was up.
Now, do you think this was prevalent throughout Wall Street, or was it just Solomon, you think?
Oh,
or not prevalent. Were other people doing it, you
No,
think?
I don't think so.
No?
I don't, I've lived a very sheltered life, Kevin and Patrick. I do remember I was filling in at Lanston. I was a long bond trader there, but I was trading treasury bills because the bill trader was on vacation.
Yeah.
And we bid for, the whole issue, a treasury bill.
By accident?
And it wasn't quite as, I don't remember exactly how it went. And I think really what happened was not like how do I put this? It's not like we thought the auction was $5 billion and we bid for $5 billion.
Yeah.
The auction might have been for $5 billion and we bid for, let's say, a third. Okay.
Yeah.
But as it turns out, of the $5 billion, half went to foreign central banks.
Oh,
so
okay.
we wouldn't have known.
Yeah, okay.
Right? So, okay.
It wasn't different divisions.
Yeah.
Sometimes it'll happen as well, right? You'll get one division that doesn't talk to the other division,
Yes.
and you'll go over limits that way.
Yes. I think that got cured pretty quick after the Solly thing.
Right.
But I don't think it was prevalent.
And do you think Merriweather, was he just, making so much money on the prop group, he didn't care about the treasury division, that's
No, I don't think so.
No?
I think it's that thing where somebody got carried away, thought they could get away with something. Based on Charlie Munger, it probably wasn't the first time that they did it. And once it blew up, the big thing about Wall Street, which people have sort of really kind of set aside, especially in the last couple of years, is this notion of street cred,
right?
Your credibility.
Yeah.
And in I don't know what it's like in the stocks, but you and Patrick could tell me, but like in the bonds, like I would do zillions of trades over the phone, and that was good.
Oh yeah, your word was your bond. I still laugh about this because I used to get calls. I'd sit there in Toronto. I'd get a call and it'd be like, Oklahoma teachers, blah, blah, blah. This is Bob. I want to buy 1 million tips, which is the Toronto version of the Spiders. And I would sell it to the guy. And I'd kind of go, hey, wait, who did I just sell it to? I better figure it out. But it would be literally just like some random call would come in, and we would do a trade, and it would just be like, assume that everyone was good for it. Nowadays with know your client accounts and things like that, that kind of crap doesn't happen anymore. But that literally, I'll tell you, that's not an exaggeration. That I got a random call from some teacher's pension plan in the middle of America, and I sold them $50 million of stock, just like boom, like that, and didn't think twice.
Different age.
Yeah, different age. Okay, but what do you think has happened? You said that this is that in those days your word was everything, your street cred was everything. Do you really think that's the case, or is it just we're old and we're no longer there?
You mean what's going on today?
Yeah, like you just like.
Well, I don't think it's much as an issue because everything's kind of point and click, right?
Oh, I see. So you're just arguing that the human element of it is gone, so therefore you're not ripping someone off to your face. It's just this faceless machine.
I want to come back to. I want to remind me to come back to a story about my trade in the May 2-year note.
Okay.
But I want to finish this first thought,
Sure.
which is
Keep going. I'm sorry to interrupt.
No. I just when you get to be my age, you gotta you gotta keep track of shit. I think that I've been thinking a lot about the current sequence of events, whether it's the cryptocurrencies or the meme stocks or just general how the banking system works. And I think what's happened is for guys like you and me and Patrick who are cross-generational, where you had to understand the dynamic of the market. And I don't mean like put call ratio or any of that. It's like, what time does the Fed wire go down?
Right.
Right. Okay. Well, I don't have a sense that anybody of the new generation understands these things. And I think that's a really big deal. To give you an example of what I'm talking about, and I'm probably going to run over my time here. So
no. We're going to make time for you, Morris. We're going to make time for you.
So let's say some knucklehead decides he wants to short a call option.
Okay.
God forbid, but anyway.
Yeah.
So if the underlying goes up and the price of the option goes up, he has a mark-to-market loss, right?
Right.
Well, in my day, you didn't have to put up the cash of the loss, but you had to post collateral.
Okay.
Well, I mean, I know, okay, but that's like a big deal because people need to understand how these things work, right? If you post collateral, that means one thing in terms of a bankruptcy. If you post cash, it could mean something entirely different. Right?
Okay.
Are you with me?
Yep.
Okay.
I understand.
Well, I could probably come up with dozens of these examples of things in the market. And since 2008, none of these things have really been tested. So, for instance, in this last crisis, it didn't take enough time before the Fed came in and fixed everything.
Okay.
Right? So you didn't get people pulling out the operating agreements and the prospectuses and all of these things going, wait a minute, if this bond trades down at this price, it's a default. And I'm going to, all those things. And so now we're in this point and click community. And I think that there's a whole group of traders, investors, that if we go into a highly volatile period or we go into some form of crisis or illiquidity event, that's the saying, bear markets find the mistakes the auditors couldn't.
I like that. I've never heard that one.
That's good. It is good.
The Fed has basically cured the business cycle. We heard that before, right?
Right. But you know what's crazy about, though, to some extent, come 2008, that was a test of the system, the likes that we probably never even imagined.
To your point, I was at a hedge fund.
Yeah.
And you're familiar with interest rate swaps. You and Patrick are. So basically, I could go into a swap with Bank X.
Yeah.
And some number of days, weeks, months, years later, I can unwind it with Bank Y.
Yeah.
And I can go, hey, Bank Y, you just call Bank X, and the technical term is novate it.
Okay.
So it takes me out of the middle and those two guys. Okay.
Yeah.
So in 2008, I did a trade with, I don't want to say bank name, but
just use X and Y, whatever.
AAA, and but these were AAA Bank X and AAA Bank Y. Yeah. And I had the trade on with X, and I went to Y, and I agreed on a price, and I said, I want to novate to
this other bank.
And they said, we're not taking their name anymore.
Wow.
Now, when AAA doesn't take AAA.
Yeah. Well, that's when the system's not working anymore.
Yeah. And so it was really only 3 or 4 hours before the market turned. And I think Warren Buffett came in and said he was making an investment in one of these.
In one of those things.
Yeah.
But at that point, that one bank wouldn't take the other bank's credit.
Right.
So do you think that was a lot closer to the system imploding than we probably believe?
Well, I think technically it had. I mean,
you think it had?
Well, if you're not going to take, if X doesn't take Y,
right,
and you're a major money bank that's too big to fail, and you won't trade with each other,
yeah,
whose credit's good? Because once again, we go into this thing about the plumbing of the market, right?
Okay.
So, and maybe this is too much inside baseball.
No. We don't want to steal from your podcast.
No. But if this is too boring or mundane, I'm happy not to talk about it. But so, for instance, everything we would do in the treasury bond market would be leveraged.
Right.
So we would, if we bought a security, we didn't have the money to pay for it. We would take the security, known as collateral, give it to a counterparty. They would give us money.
Yeah.
Okay. So if I'm short something, I would ask to borrow it. They would give me the collateral, and I would give them money. And so the security for both parties were the haircut, right?
Yeah.
Okay. Well, we were at the point where we had to go. We got an attorney and explained to us what our rights and obligations were if our counterparty went bankrupt. So I don't remember exactly how it was, but every night before we went home during that period of time, we ran an exposure report. And so it basically said something like, if we come in the morning and bank X declares bankruptcy, I'm short 200 million 5-year notes.
I get it. Yeah.
Because one collateral gets treated differently than the other collateral.
Exactly, yeah.
And so who do you think's running those risk reports today?
I don't know. I'm
Yeah.
not sure. I think everyone's assuming the Fed's going to be good with it. I'll tell you a quick story about that 2008 that I always think was amazing. So, total return swaps, although these days people use it to corner stocks, a lot of the kind of in my day, it was used for tax trades, right? Because dividends in Canada for stocks are treated differently than dividends for for Canadian residents or Canadian entities, they can gross up the dividends. So the reality is that if you're sitting there and you're somebody that doesn't get that benefit and you're long the Canadian stocks, you're better off actually swapping it into a Canadian bank that can gross it up and then, in essence, share part of the profit of that tax gain. Well, there was a big bank that did this, and this trade was abused by many banks. My bank wouldn't ever let us do that, so we were constantly trying to figure out ways to go the other way and actually have the trade on backwards. But there was another bank that was very aggressive in this kind of circle, and so they did their trade, and they had it on with Lehman, and so they had this $1 billion, almost $1 billion of swap, and then 2008 hits, and they start getting nervous about it and things like that, and they decide to unwind it early. So they unwind the swap early, and they unwind it like on the Thursday or something like that.
But did they unwind it with Lehman or somebody else?
No, they unwind it with Lehman. Okay, so they unwind the swap, they pull the trigger on it, and they unwind it, and they just do a trade for stocks on the other side, right? Okay. So they trade for stocks on the other side. The trouble was that they, in the meantime, because back then stocks were 5-day settlement or maybe not 3. Lehman went bankrupt.
Yeah.
And so they literally were going back and forth. And my buddy's telling me the story. He says, we didn't know. Were we long $1 billion of stock or were we, or were we even? And it ended up being they were long. And so his boss gave him an order and said, get this off the sheets like this afternoon. Yeah. And, $1 billion moves the S&P, forget about Toronto.
Yeah.
It was just an unbelievable, I don't even know how to describe it. Like fire sale is is giving, but again, that was a case where nobody knew where they were. You didn't know what your positions were. And anyways, I hope that that was the worst. I keep thinking, Morris, there's no way I'm ever going to see anything that bad again. Yeah. It doesn't sound like you're as confident as I am.
No, what's that thing like old men yelling at clouds?
Yeah, well, this is Bart Simpson.
Something.
Yeah, so you're like the old man yelling in the clouds. So you think that is more of a chance than the market probably understands.
Yeah, go ahead, Patrick.
The reason I agree with Morris is because,
of course, because it's bearish.
No, not only that, but it's a function of the fact that everyone uses so much leverage, and leverage is always treated the same way. Margin is treated the same way. Risk levels are treated the same way. And so while we've dealt with these circumstances before, the underlying condition of high degrees of leverage still exists there, and therefore, in some degree or another, the risk still exists. It's just how it won't manifest the same way, but the underlying condition is still there.
To your point, I didn't realize this, which is actually awful because I heard Charlie Munger mention it when I watched his interview today. The Fed sets margin requirements, right?
Yeah, even on stocks.
Yeah,
but I've been arguing this for a while.
But the banks get around it with the total return swap.
For sure. And listen, in my day, we used to go and there was two entities. There was the bank and there was the dealer. Mm-hmm. And so I would trade on the dealer's books, but we could actually book things at the bank if we wanted to. Yeah. So the aggressive ones would just go and book them all at the bank. And there you have to put up BIS rules, which I don't know what it is now, but back then it was like 4%. So you could do trades that you could just lever up and use the bank's balance sheet. But so that is the argument against kind of the Regulation T, which is the margin change. Like I think it hasn't been changed since like 1973 or something.
I think that's right.
It's been a long time.
Hey, let me tell you this last little bit about that 2-year note thing.
Yeah, because, let's go back to it.
Because I'm not confident my book is ever going to get published, and this would be a great story for my grandkids.
Okay.
And at this point, you're laughing about my book. That's a whole nother show. So I was at Deutsche Bank, and for whatever reason, I was short 300 million of these April 2-year notes, and I roll them into the Mays, right? Because I didn't have to borrow them, and I was getting squeezed mercilessly. I hated the thing, and by then it was trading like in a 2/32 market.
Right,
for a 2-year note, it's crazy, right?
Yeah.
I mean, it's
like
it's
super
4
tight.
basis. Yeah, it's 4 basis points. And so one of the salesmen stood up and said, "I got a new account. I think it was from like Minneapolis. They want to sell 300 million of the May 2-year."
Oh,
and the 2-year note trader says, "Well, I don't want that fucking thing." Nobody wanted to touch them. And I'm sitting there, and I'm like, no one, since this thing has been created, has been able to buy this thing on the bid side.
Yeah. Okay.
So I said to the guy, they were like 22.24. I said, "I'll pay you 22 for the 300.
Yeah.
And he says, done.
Yeah.
And, that feeling of relief, what it's like when you're being squeezed on something, which usually means it's the high.
Yeah, that's right. Yeah. You just got plugged.
So anyway, I go about my business. And Cheryl and I were living in Greenwich. And so I would drive down to the train station. It would be like 20-minute drive. I'd get on like the 5:30 in the morning milk run, right?
Yeah.
And it was a local at 5:30 in the morning. And so I'm sitting there with my, wool overcoat and suit and tie and Patek Philippe watch and church's shoes. And I look at the Wall Street Journal and the right column, was that like human interest thing?
Okay, yeah.
There was a story about some guy from the Midwest that picked up, moved with his family, and the first trade he did was short this 2-year note, and he lost his job. And that was the guy that sold them to me. And I just got to tell you, so on that podcast I do with Liam Allen every week, the Inside Baseball thing, I have so many of these frickin' stories that just are so crazy. And it used to be he didn't believe me. And now he's verified enough of them.
That's so funny.
Anyway,
you picked up some poor guy from the Midwest who's lost his job. Listen, you gave him a market and he hit it. Like you did it.
And just for sake of clarity, I was on the prop desk. It's like the dealer didn't even want it. So, but yeah, I picked him off. Remember, guns don't kill, people kill.
Poor Midwest guy. trying to make a market. What was he doing trading 300 of those? I think he'd start a little bit like he thought they were expensive. Like you did.
Probably at that interest rate, probably the $1.01 was maybe a penny. I mean, it's.
Okay, so let's talk a little bit about the markets and what you see here.
Oh God!
Come on, we got to hold your feet to the fire. We got to do it. We're here. You being a big believer, I think you've reminded me about the sugar high that we were going to experience. Do you think the market's woken up to the fact that it was nothing but a sugar high and the economy is not as strong as everyone expected?
Well, I think people are talking about it. It's just the thing why I'm done predicting the stock market is because I didn't scrutinize it, but the Chicago Purchasing Manager Survey came out today.
Yeah.
And it was the biggest drop on record.
Right.
Right. And so what happens? Bonds rally because of weak economy, and then the stock market goes up.
Well,
I don't.
Stock market's going up for a different reason. If you should know it's the S&P option whale, right? It's the big that big option structure that the guy rolls every quarter end, and they rolled it today. It's something 25,000 contracts. It's monstrous.
I forgot about that. I've been focused on India lately.
Yeah. See, but if you were on Twitter, we would have been talking about the option whale as well, and I would have reminded you this morning to watch for the S&P option whale. This J.P. Morgan structure is just monstrous. It's just it's huge. Actually, I just realized I went through a great thread that I can't remember the fellow's name. I'll just grab it here. But he did a great thread, and he went through it, and what he did was he talked about the fact that here it is, Pat Hennessy. He had some terrific stuff. Pat Hennessy on Twitter, and they've gotten so big with this fund of theirs that they're doing. Mm-hmm. They've actually realized they're affecting the market, and they're now staggering. They're making new funds with different maturity.
Staggering their strikes.
Yeah. Well, not their strikes. Their maturities.
Expiration.
So they were done quarter end, and the trouble is that now they've basically become this whale that everybody knows and everybody's hunting against, and. So at the very least, they should do it. And this is an interesting thing. One of the kind of offshoots that's kind of strange about this idea that we no longer have options that are just listed on the third Friday of every month. We now have dailies on a lot of stuff, weeklies for sure, quarter end, whatever you want. It almost seems like it's. So I almost think that one of the kind of interesting offshoots of this is that we're going to have a situation where those seasonal tendencies from these options, as they get spread out over more periods, won't be as strong.
That makes sense to me.
And in your day though, like you would trade options in the fixed income market, it would all be custom, right? You wouldn't do standard.
Well, there were two. There would be the listed options. Right, on the futures.
Right, but were they liquid? Like, would people trade those? Oh, yeah?
Yeah.
And would you take that down to the pit?
Yeah, so in fact, one of your guests and fellow raconteur, Harley Bassman, he was at Merrill, and he would trade options on the cash bonds. Yeah. And so one of his guys introduced me to these basis trades where you would do the cash options against the futures options.
Oh, I see.
So
okay.
to not to show off who I rub shoulders with, big shots like Harley Bassman, but the point was I would always do the cash side first, meaning with Harley first, because I knew that if I moved the future side by a plus, that I could get the size done. Right. Whereas if, Harley changed his mind, it was 6 ticks. Right. So that told me that it was, because they didn't, they weren't there to give you plus markets and stuff, right. But there were guys on the floor, that were competing. So
right.
you always had a market. And I think once it got going, and it started when I was working part-time down there. So that was probably early 80s. That once that thing caught fire, because if you know that the Chicago Board Options Exchange was a spinoff of the Chicago Board of Trade.
Right.
So you had a bunch of SIBO guys upstairs come down into the bond options once they started trading bond options. Okay. So there was already a pretty good market maker, ethos.
And so would you not do upstairs trades, like meaning that if let's say you went and you wanted to buy, let's say a 3-month at the money call against underlying, would you just not even bother like doing it upstairs and then taking it down to cross? Like it would all be done down on the floor? Like all the liquidity gathering and all the different markets would be created down there floor? Because like for us, we would go and yes, there was a floor downstairs where we would cross things and we would have to open up parts of it to the pit, but the reality that the real price was set upstairs.
So in my day, the cash trades on the cash securities were done in the quote upstairs. Right. The future stuff for the bulk of my career was all done on the floor.
Okay.
If you could do basis trades with counterparties so you do the cash, and then you would do a futures trade called an exchange for physical.
Right.
EFP.
Yep.
And that you had to make a note on the ticket, but that didn't have to go to the floor.
Right. Okay. But the floor was that liquid. Like they would trade with the upstairs guys.
Oh yeah. There was a huge. So it was really kind of cool. So the bond room, once it grew, they moved the grain room into a new building. Okay. And so you had the bond pit, and as you're facing the building from LaSalle Street, so as you're facing south, on the right was the bond pit, and it was massive. There were like 300 people.
Yeah.
And then to the left of that was the bond options.
Right, okay.
And so you had people standing on the top step of the options and the top step of the bonds signaling each other. So if a local bought 2,000 of some call and needed to sell 400 contracts, he would just flash to his guy on the top of the step of the options, who would flash it across to the bond guy, and they would execute the trade. And then as you headed further south, you had the 10-year note pit, and then a little bit east of that was the 5-year note pit. Right. And the 5-year note area, when I started trading professionally, the Paul Tudor Jones story.
Yeah, right.
That was the 5-year notes.
Oh, that was the 5s.
Yeah. The 5-year area in my day, maybe still, but you had this nice combination of volatility and size. So like the bonds would move, but you couldn't get that many bonds off before you'd push them left and right. So like a Solly story, so we had a client when I was at Lanston. It was a stockbroking house, and they were very bullish on bonds back in the mid and early 80s. Okay. So they owned 15%, 14%, 13 and a quarters, 12 and a halves, 12s, 10 and 3/8. Yeah. And so at some point they got to the time they wanted to take a profit. So they would call us up and they'd say, look, we need to bid on 100 million of the 13 and a quarters of 2014. Yeah. And I don't know where, let's say it traded 140. I mean, I would have no fucking idea, I would have no idea where those bonds would trade. So I would call Solly and they would scratch their heads, and 10 minutes later they would come back and they say X. Yeah. And I would say, look, to the client, I can pay you X minus a quarter point because I wanted to make a little something. And he said, done. So I sold Solly the 100 million. And like an hour later, the same guy comes back and says, I got 100 million more of these things. And so I call Solly up and I'm like, same guy, another 100. Now the market hadn't moved. Yeah. And Solly's like, well, another 100. And he marked him down a full point. And the guy traded him. Now, you tell me in this era, right? Yeah. How would that go? I mean, it'd be a couple of ticks, right? You would think, and
Yeah, well, things were definitely less efficient back then.
But even in '08, okay, and I'm willing to. Too bad we can't make this skin in the game, but it was, I believe, in 2009, or yeah, maybe 2009. The U.S. Treasury auctioned a 7-year note. Okay. It had a 70 basis point tail.
Oh yeah, I've heard the story. Yeah.
Well,
it's crazy. Why don't you explain to people what that means? Explain to
So basically, a tail. You'll have an auction, and it'll be trading WI when issued.
Right.
And when it's a when issued, it trades in yield. So you'll have its maybe 5.11 bid at 5.10, and then when the auction comes, if people expect it to be a 5.11, but it comes a little cheaper and it comes at 5.12, you would say that's a 1 basis point tail.
Right.
So when you go and read Zero Hedge and they say today's 2-year note auction had a 0.5 basis point tail and it was a total disaster, right? So this was during one of these chaotic periods, and we were getting just our nads squeezed on this like old 7-year note or an old 10-year note, whatever it was, and once we were like that thing about when you're too big, you can't be wrong. But we were too big and we couldn't be wrong. And we were wrong. And they, out of the blue, like at 10:30 or whatever, they're like, we're going to have a special auction of this thing like in an hour.
Oh, okay.
And like, ooh. I mean, it took us from being down to up.
Wow.
By a lot. Oh, yeah.
Holy smokes.
Yeah.
Did the Fed do that on purpose to save everyone because they knew they were in trouble on this?
Well, they panicked.
Yeah.
But yeah, it was like, we got to do something.
Yeah.
And
well, actually, that's not the Fed. That's the Treasury. I'm speaking wrong.
I'm glad you said that because lately it seems as if they're joined at the hip. I've gotten confused.
Okay, so listen, I got to keep you on the spot here. So you think it's a sugar high. You think that, the economy is not, it's going to be as strong as everyone expects.
Yes.
Do you think that we're headed just to the old, like, environment of maybe rates at 1% or even lower?
So just the one thing I can't get my arms around, okay, Patrick had asked me off camera about the reflation trade, right? So the thing I can't get my arms around is you had a period of time, let's say it's 6 months, where the economies were pretty much shut. Right. You had the world sitting at home. And that hole appropriately got filled by the foreign central banks. Right. And so if you were getting money sitting at home, I mean, that was fine. Right. But I don't think people are looking at the whole effect of the global balance sheet. And there's a hole that got created and just got filled with money by the central banks. And so I don't know. I don't think people have taken into account that's a real loss.
Okay.
And once somehow that works its way through the system, maybe a la Lacey Hunt, I think that it's going to be a tremendous drag on growth. That's the first thing. I think consumer psychology, I mean, I have 3 grown daughters, wife, sister, brother. And I've seen changes in behavior on how people view things. And I don't think that in aggregate, other than people running out and buying an electric sports car or fancy house in Scottsdale, Arizona,
I don't know who you're talking about.
I think there's going to be a change in behavior. There's going to be less consumption. And so I think we go back to the, 0 point something to 2 point something growth. And I don't think there's the political will to start raising rates. And certainly Powell has a gun at his head because his term is coming up here at some point. And Lael Brainerd.
Yeah.
Did I pronounce that right?
I think you got it right. Sounds good to me. But you're talking to Patrick and myself.
Exactly.
We don't get very many names right.
Yeah.
I got a 50-50
Moser.
hit, right?
We're still going with Moser.
Yeah.
Moser.
Moser it is. All right.
Everyone gives tips on what they think and trade ideas and stuff, and I'm perfectly blunt about this. Other than some greatly diminished premium on precious metals, I just have my money sitting in cash, which is the strictest or the purest way I can prove to you that I don't know what's going to happen.
Right.
And I'd rather play from a neutral, and it's cost me.
And do you think that, you mentioned Powell and you mentioned that his term is coming up. First of all, do you think he wants the job?
Oh, yeah.
Yeah, you think he does? You think he wants to
nobody ever wants to give up power, ever.
Okay.
It doesn't happen.
And so then the next
are you thinking of giving up being the Market Huddle podcaster?
I don't know. Someone, a big enough price, and I would be more than happy to do it. And I don't know. I think the price might just be letting me renege on all my beers that I owe Patrick, and I might call it that even. No. So do you think that? So the next question is, you don't think that Powell wants to give it up. The next question is, do you think he will be forced to give it up?
Maybe.
Yeah. Like you think?
Yeah. Well, I think there's a big push to broaden, women and minorities in government, and Lael Brainerd is a highly qualified woman, and I think they're trying to do that now.
Okay, so if they do that, do you think that the Fed will have any policy changes? Because, to me, I don't know how much more dovish they could be.
I believe that whether it's Powell or Brainerd, okay,
yeah,
with those two combined with Janet Yellen,
yeah,
that the Fed will be so easy that they are going to get the unemployment rates for minorities. And I'm not being unpolitically correct, because I looked it up on the BLS website. So there's white, black, Hispanic, and Asian. Okay. I've read that on the internet, so nobody can claim me as a hate speech guy, right?
Okay.
But the Asians have the lowest unemployment, followed by the whites, then the Hispanics, then the blacks. I believe that's how that goes. And I think the Fed is going to keep their foot to the pedal until you see Hispanic and black unemployment substantially lower than it is today, even if it means the unemployment rate goes to 2% or something.
And so do you think that means that this slight pivot towards what the market interpreted as a more hawkish Fed was them just paying lip service, and it wasn't really as much of a pivot as the market believed?
Oh, absolutely. I think it was let's get these guys off. Let's get Stan and off my back.
Right.
And if you just break down to things he's said and try and be a second order thinker, okay. He said they're going to base decisions on actual data, not forecasts.
Okay. Yeah.
You remember hearing that,
yeah,
right?
For sure, 100%.
Okay. So these guys, in terms of forecasting, they can't find their ass with both hands. So, and even I, as arrogant as my own abilities as I am, I wouldn't attempt to forecast rates in 2023.
I know, it's crazy, isn't it? It's crazy. And then the market's sitting there, they moved by, whatever. And it's nuts that we're sitting there. It's completely just picking a number out of the sky.
Yeah. So somebody asked me, it must have been Liam on the podcast. He was talking about bond guys are the smart guys, stock guys are
you can say it. That's okay.
Dumb guys.
Yeah.
The reason I off the cuff I said to answer Liam was that, so when you're dealing with the 10-year note at I don't know, where is it, 145 or something like that, ish, plus or minus. That's a real number, and nobody's buying it at 145 because they want to.
Right.
They're buying it because they have to. And if they have to buy it, it's because the amount of money, the state of the economy, the forward yield curve. Okay. If somebody buys, I'll pick on Tesla. If somebody buys Tesla, they're saying, well, the PE at 300 is right.
Yeah.
Well, how you get 300 versus 250 or 400, I don't know. But I can show you how you get to a 10-year note at 145. And so what a 145 and a 2% bond tell me is that there isn't inflation, and there's not going to be inflation, and there's not going to be any growth.
Okay.
It's just that simple.
And so,
music to my ears, like Kevin. It's like he's truly a wise man. You should pick up a few.
Can I go grab my wife and have you repeat that?
Absolutely. You can just play the podcast back.
She doesn't listen to my podcast. How's she going to listen to your podcast?
Okay, so then why don't we just end with gold and the silver? It's been a huge disappointment for me too, right? And I was actually surprised how poorly it took what was really like this hawkish shift, but it really wasn't that much of a hawkish shift. Do you feel like that we might be getting close, or are you closer to giving up on the precious little yellow fella?
So my son-in-law has a trade on, I think, and he was asking, because he's not a trader.
Yeah.
I wish he would be, because he would just be fucking awesome. But he put together a trade idea. He showed me, and we went through it, and he's crushed it, which is great. But the question came along at some point about, it's like, what do you do? And so the point with him and the way I'm dealing with my gold is, it's like gold and silver, I got into it. I committed a certain amount of money, and until the facts change, I'm going to stick with it. And now all of a sudden it's not quite as much of a commitment, right? Because of the time decay and the drop and fall. But I do have, and I hope you don't get mad at me, but I've turned into like that Greek-sounding guy who was going after Madoff.
Oh, that guy.
Harry Markolo?
Yeah, I don't know how to pronounce. Listen, you're asking us to pronounce the last name again.
But long story short, I got a bug up my ass about this tether thing.
Oh, listen, I'm with you.
And so I don't know if you're aware of this. I know you've got the big CFA degree, but I have a measly CPA, but I've gone through the auditor's reports, and it's like, these things are fucking worthless.
Yeah. Oh yeah. It's crazy. There's a terrific. I'm going to send it to you because I know you're not on Twitter, but there's a terrific guy who made a 10-minute long YouTube, and he went through all like the history of Tether, how it came to be, and the individuals involved, and it's just I sat there and I was like, come on, this can't be. Like
Liam sent me this article. The guy I think started Tether. He worked at Morgan Stanley in like 1997. He got interviewed by the New York Times, and he was talking about all the money he was spending and the models and bottles and the Rolex watch, and Morgan Stanley fired him the next day. This is the guy who's like in charge of the...
Oh, and listen, it's worse, and I don't want to say anything more. I'm going to send you this. I am completely and utterly convinced that if crypto ends up having problems, it will be from these stable coins. Because to me, I think that a lot of crypto holders are quite prepared to have volatility in the actual underlying asset, whether it be Bitcoin or Ethereum. And like, let's face it, they just had some wicked volatility, and they've hodled, and good for them. Listen, and it hasn't collapsed. Look, for example, the Grayscale Trust, I would have thought that would have caused a whole lot of pain. It didn't. For those who did the trade, it hurt, but I think, though, what I'm worried about is that I think very few are expecting to get crushed in their stablecoin. And I think that would be the kind of... Listen, you know as well as I do, crises are never made for things that everyone warns about. Right?
It's the unknown unknowns.
Right. It's the thing that everyone knows can't happen that ends up happening, that ends up, taking down the system. And to me, when I listen to the Tether and I just listen to them say, oh, it's, they can print it just like a central bank can print it. I go, listen, it's completely and utterly different. One of them is a government that has the ability to tax and to tell you need to pay your tax in those dollars.
But they got like $60 billion, right?
Yeah, it's a monstrous number.
So let me just say this and keep this between you, me, and Patrick. Okay.
Okay, just keep it on the down low.
If I had a shot, a snagging 10 bill, and taking off somewhere, I might take a shot.
Well, I'm kind of sad to say that I do it for a couple of less zeros than you. I know, it's crazy. It's.
Well, how about those two poor kids in South Africa?
Oh yeah, the poor.
Those poor
they're
kids.
very
I
poor.
hope they're
very
okay.
very poor.
I hope and simultaneously $3.6 billion worth of Bitcoin went missing.
Yeah. Well, there's one here in Canada as well. Patrick, what's the name of the guy that the Nova Scotia kid that
Oh, the one that went to India?
Yeah.
And died?
Yeah, quote unquote died.
My brother tells me you can get a death certificate in India for like $20.
That's awesome. All right. I'm going. No.
I know we're way over, but it reminds me so much. I mean, watching that Elizabeth Holmes Theranos thing, as it was unfolding, and I'm like, okay, here's a woman that she's a 5 out of 10, but with all the money, she's like a 6.5 out of 10, and her board of directors is Henry Kissinger, George Shultz, Mad Dog Mattis, all three. Noted in the field of biology and medicine. Yeah.
Oh, God. Okay.
Yeah.
Well, listen, on that note, why don't you tell people where they can find more?
Sure.
They can get this on a regular basis.
Thank you. Yeah.
Make sure.
So we have a podcast. It's produced, directed by Liam Allen, and it's called Inside Baseball with Old Chestnut.
Okay.
And we've got 24 episodes so far, and we try and do it once a week. And it's all because of you and Patrick.
Well, listen, I'll tell you, there are so many people that have come to me and have just said, I love that Morris. I could listen to him all day.
Oh, thanks.
I get so many people that just come and they say, I really, really, I'm so happy that he's doing it. I really enjoy it.
Oh, thank you.
I think my dad actually listens to yours on a more regular basis than mine.
Well, he taught you everything you know, not everything he knows.
That's
right. Well, say hi to your dad, and
I will. I'm sure. Well, listen, he'll probably be listening to this because he found out that you're on. So I'm sure he'll stayed on to our show. He'll see Morris. I got to stay on for this one. Okay, so once again, Inside Baseball with Old Chestnut, found where all great podcasts are distributed.
Yeah, wherever that is. Yeah. I think.
And listen, we're going to tease one last thing. We're going to have a special this summer, right? We're trying to find some content. It's going to be actually Morris and myself, and I think Morris might be planning on turning the tables on me.
Oh,
yep.
It's going to be good.
It's going to be a lot of fun. Okay, thanks again,
right.
Morris. A real pleasure having
Morris.
you on. Thanks for making time.
Good to see you guys.
Okay, Patrick, time for talking charts. Should be an exciting week. What do you got for us?
Let's talk about some stuff. First of all, let's go through last week's top 3, get to the top 3 things to watch next week, and then we'll look at some different charts. So let's start off with what we were looking at last week. And first thing we were just observing was the huge run we saw in nat gas on the upside, and asking, really how far can this go? And it was truly an acceleration to the upside. I think obviously the weather and other variables have contributed to the most immediate rise right in here. But this week it's slowly getting a little heavy up here. I think that this is a little bit overdone. maybe it's time for it to stall out here, but it certainly didn't run too far after we talked about it. We seem to goocher things all the time. Right?
I bring on your pessimism. I like it.
You like it?
I like the fact that you're
at least you're not short the Widowmaker, right? Like,
no, I'm long all these nat gas. I love it. I the whole energy complex. I love it. Yeah. Don't want to talk about it anymore. Jobs numbers.
Right, so jobs numbers. How did they come in?
Well, they were hotter than the market expected. But what's interesting is that it really didn't do anything to the bond market. It was kind of an non-event. Everyone's gone up to the Hamptons. They've split. There's nobody left on Wall Street. It's been a snooze fest.
There you go. And the other thing we were watching was the rotation.
Actually, one second before you do that, I don't mean to interrupt, but I will interrupt. I actually realized that there was a big article on Bloomberg about how it's the July unemployment numbers are twice as volatile as any other unemployment numbers, because of the lack of liquidity and stuff. And I think Ed Holenbrook or something wrote that article. I realize right now that he goochered it.
He did.
He did. He caused it to be less volatile by writing that article about how they're so much more volatile. Or maybe it's J.P. Morgan. Somebody wrote this article. Actually, now that I think of it, it might have been J.P. Morgan. But regardless, this is generally considered one of the more volatile ones because it's illiquid, and yet it causes outsized reactions. And it was the most boring unemployment number we've had in months. Okay, number one, what were we watching for?
We were talking about that rotation into growth as a new trend, really highlighting the fact that the NASDAQ and those FANG stocks really have been the leadership in all of this, right? And so this is the FANGs futures index, but when you look at any of the individual components, particularly like Microsoft, even Apple, all of them have just been running hot. And what's particularly interesting about that, Kev, is that it's one of the very few sectors that made fresh highs.
Yeah.
Even though, like this one didn't make fresh highs on the FANGs index, but it was the relative strength. I mean, I think it's almost 20% in a month. Hold on, let's see here. Yeah, it's up exactly 20% in a month. And but it was really the NASDAQ that made that fresh breakout, really accelerating to the upside. And when you go sector by sector in the other components, very few other sectors within the market are participating with them. It's a very thin market this way.
And that's why you should be a big picture member, because it's those lucky few that got told by Patrick that you should buy all those stocks.
There you go.
And Market Huddle, you've been pushing these and you've been absolutely spot on. And your favorite is Microsoft. And as we're taping this on Friday afternoon, and the thing's screaming. It's up $6. Yeah. It's new highs. Why don't you pull that chart up and take a victory lap?
Well, sure, absolutely. Let's take a quick look at Microsoft here. But
was this your top pick out of the FANGs?
Well, it was one of our breakout trades on the upside.
Oh, okay.
And you can see it ripped right to the top of the profit-taking zone box there. But yeah, like it was a great move. But I think that it's a little bit long in the tooth here, but certainly a huge move. A huge move on the upside. Anyway, so but that certainly has been the case, and it seems to be continuing on the short term. So anyway, let's go on though, Kevin, talk about the top 3 things to watch next week. And what I wanted to really touch on that I'm watching is the fact that the energy stocks seem to be not confirming, or at least not participating with the big advance in oil. I mean, me and you will talk a little bit about oil when we settle a bet, but crude oil hasn't quit, right? Like this has been a very distinct bull breakout, and this trend is just ripping. But and I know that like you and our good friend Cuppy have theories about the long-term prospects of oil, where oil could be at the end of the year, or what the 2025 contracts will be doing. But really, this has been a story of steep backwardation, right? And we continue to actually see only the biggest participation higher at the front month of the curve, and really the interesting part, it looks like oil's going up every single day. But what's interesting is that typically you see the stocks associated with the commodity, like in this case the energy stocks, typically would participate on the upside with this type of a move. But when you start looking at the different energy components, this is the XLE hasn't made a higher high in a month. You take the XOP, which is the exploration one. It's still trading as highs, but not hasn't broken out. You take the refiners, like in the crack ETF. Basically is off of its highs and been distributing downwards. You take the oil service stocks like OIH, they've been more or less selling for a month, and so what we're seeing is that the strength in oil is there in the commodity, but it isn't getting the energy stock equity traders excited at all. And I'm wondering what to read of this kind of divergence. Is it just because there was such a huge overweight in energy that now that everyone's kind of rebalancing their overweight to more of an equal weight in this kind of using this oil strength to do it? Like, do you have any theories on this?
Oh, I think everybody's listening to you and buying FANGs.
Well,
no,
that's
seriously.
clearly what's happening.
Yeah,
but
no,
you would think,
serious,
you would think that energy
you,
stocks should be at least the correlation has always been strong with the trend
Patrick,
of oil.
I think you nailed
energy.
it when you talked about the fact that the curve is in this big huge backwardation. The majority of the gains has been all at the front end of the curve. If you go look at like 2025 oil, it's barely moved. And if you think about when you're pricing out a company like Exxon or whatever, it's not just the front spot month that matters.
You're assuming everyone is using fundamentals for this, though, Kev. The bottom line is generally there's a sentiment that comes with it, and so as oil's making new highs. Typically, it gets people wanting to participate, and they want it.
But Patrick, I think that one of the things that's dramatically different here is that the reason oil is making new highs is because supply is being curtailed because nobody wants to invest in oil stocks. So it doesn't like, for example, although I'm
a seller on your nonsense. No, that's silly.
Okay, well, that's what makes a market, but that's what I think is the fundamental reason for the bull market in oil. And therefore, they're starving out supply by, making it difficult for people to invest in
I heard there was some imbalances in at Cushing where basically they had the wrong types of oil, and there's and even though the tanks are full, I don't know. Like,
it's you guys with your tanks are full all the time. Like, this is like the common thing. Like, that's all I hear about is the.
But I'm just saying is that.
But isn't the tanks full? Shouldn't that cause the opposite? Shouldn't cause tanks get full in Cushing cause the actual?
No, the wrong type of oil. That it's the light versus heavy shit, and and there's short-term supply and demand stuff.
Too? Like, I don't think I don't think it's.
Yeah, Brent is edging higher. I mean, it's not breaking higher with the same velocity, but it's got the similar trend for sure. Yeah. But all right, anyway, let's go on. So number two thing to watch, FOMC meeting minutes as well as the Reserve Bank of Australia.
I think these are two actually important things. FOMC meeting minutes, usually that doesn't matter, but in this case it actually might, because we're looking for clues about changes and shifts at the Federal Reserve. So, seeing what they were talking about and what they're trying to signal there is important. But the RBA, the Reserve Bank of Australia, is interesting. I'm going to actually just lift something my buddy Dave Lutz wrote. I don't know if he's actually lifted this from someone else, but I don't know. He's long gone. A typical sell-side trader. It's 4:00 on a Friday. There's no way he's at his desk anymore. But anyways, Tuesday's Reserve Bank of Australia meeting is shaping up to be a blockbuster. The fate of RBA's 3-year yield target and bond buying scheme will be decided, or scheme, as Patrick would say. The language on the rates outlook is potentially altered. At least one hint is implicit. Either the RBA rolls over the yield target set at the cash rate level of 0.1% from the April to November 24 bond lines, which signals steady rates until then, or it doesn't, opening the door for a move sooner. Anticipating a rates liftoff in 2022, investors will watch Governor Philip Lowe's unusual post-meeting news conference. I think it actually is an important one to watch. If we looked at kind of Australia from a COVID basis, they're still far behind a lot of the rest of the world in terms of getting the vaccines out. And yes, they're managing it well, but their economy is a long way from being open. So it'd be interesting to see them go hawkish even as they're struggling with opening their economy. I do think it is an important thing to watch. I don't usually say this, Patrick, but I do think that this will set the tone for a lot of different central banks in the coming days.
Well, thanks for sharing. I will be watching. Number one, I wanted to watch whether or not the breadth of the market reverses. And like we talked about in that FANG theme, while it appears the S&P 500 and NASDAQ are ripping away, it is actually a very narrow scope of stocks that are actually driving this rally. And the breadth of the market is actually quite weak. And it doesn't necessarily mean it's bearish, but it's certainly something that is the reality of the circumstance. But one of the things to me is that if the stock market was going to make a substantial advance even further higher from here, you would think it would come on the back of the rally broadening out. And more stocks participating versus just a few FANG stocks that keep ripping. And so one of the questions I'm watching next week is, will we see that breadth rebound? So here, this is a nice chart that I like to track for this. And it's a very simple thing of simply tracking of all the New York Stock Exchange stocks, how many of them are actually above their 50-day moving averages.
Okay.
Right, Kev? And if you notice, even though the S&P and the NASDAQ are ripping to new highs, this is actually declining, which basically means fewer and fewer stocks are actually participating with this rally. And that makes sense because if you look, the market cap weightings of the FANG stocks into the index, it's easy for the FANG stocks to carry the weight, right? As long as they're ripping the way Microsoft is, the index is going to go higher. But what I think that if the S&P is going to make a punch to 4,500 or 4,600 or some big thing, I think the rally has to widen. At least I'm speculating that it would have to widen. And so I'm going to be watching as to whether the breadth returns.
Well, there you go. That's an important thing to watch. That's all the technical voodoo that I don't know anything about. So I'm going to leave that to smarter.
There you go. Well, you know what?
Yourself.
Let's take a look at that. Okay, let's go through a tour of charts. Let's actually look at the sectors. I mean, we spend so much time talking commodities and things like this. Why don't we actually look at the different sectors and what they're doing? All right, and so let's use a lot of the Spider Select ETFs as a way, and this is the technology ETF.
I feel like when you said that, it was like a product placement. What new Coke Zero? Spider Select, please send us your check. Of course they didn't send us our check, but anyways, go on.
Yeah, but anyway, you can see where that NASDAQ rally and the tech rally is really being driven, right? The technology is where you clearly are getting the money flow. But even look at something like if you isolate just the social media stocks. Now, obviously, this particular ETF weighs a little bit more into Chinese social media as well, which have been dogs and lagging. But you can see that not all the spaces are participating. Look at the financials, right? The financials during that cyclical rotation from November to April and May, the financials were the leadership alongside with all the cyclical stocks. And really, the financials have just not participated in the last month.
Yeah, it's been your month, buddy. It's been your month. All my stocks have just been dogging it. The KREs, look at this thing, terrible.
Yeah, the regional banks have been dogging it.
Shit.
And up until today, even the consumer discretionary stocks didn't make fresh highs. Today is the first 52-week high of the consumer discretionary that just joined the party right now. But it really was a laggard for a while. But you take consumer staples that have not participated. We look at retail. Retail's been crawling higher. But one of the other spaces that have been doing relatively well is healthcare. Take a look at the healthcare one. So you're really still seeing a lot of these healthcare stocks really ripping. So along with technology, I would say you're seeing almost an acceleration in a lot of these healthcare stocks. But when you go to something like the mining stocks, this is the metals and mining, have not participated. You look at this is the materials index, has not participated. Energies have not really moved, right? Like you just have, even like utilities can't get off the mat. The point is that you can see where the breadth is being offset. Like there just isn't a very broad base to this that is driving 52-week highs. And now the bullish spin on it is if suddenly these sectors suddenly do start to participate, they could take the S&P to a whole new level. And that's why I think it's such an important thing to watch as to what, because I don't know, while I really like this FANG story, I think it's a little long in the tooth for this impulse anyway. And I just don't think that if everyone's counting on them to carry the weight, then the market doesn't have much more upside, is my opinion.
Well, that's some good stuff. And, listen, you've been so right on the FANGs. I'm going to listen to you.
Oh, whatever, buddy. Okay, I don't know. It's knowing you, there's a good level of sarcasm in there. But
come on. Every time
anyway,
I see something nice, you think I'm being sarcastic.
Yeah. Why would I ever think that? Anyway, interesting. Let's talk some commodities and stuff. Interesting bounce in gold and silver. So at least they seem to have put in some sort of short-term lows.
God,
now, the question
from your lips to God's ears, man. Sure hope so.
But I think the big stress test will actually come in mid-week next week, which is they were so oversold that some sort of a snapback retracement is a natural reaction. But actually, whether the bulls build on a positive uptick is actually the big tell. And so I think the jury is still out, and I think early next week's price action is going to be really important to kind of size up what's happening there. The other thing I wanted to just circle back to is just like what's happening in these bonds, because like when you look at that 30-year yield, it just keeps going down. It doesn't seem like the bond market.
I just need to getting that screw, just pushing it in.
No. A screw. Why would I use a screw when I have a knife? I'm just gonna jab the knife deep in there. But
it's like I have a bullet wound and you're pushing your hand into it.
The finger
into it or whatever. Yeah,
into the finger. Yeah, but I don't know. Like. It's I don't know. There might be a few people that own some bonds over the last couple of weeks that have been taking the other side of your trade.
Yeah, listen, there's some bond bulls that have done quite well for themselves. So congratulations.
Well, it's only a reaction so far. We'll see whether or not it has any teeth. But anyway, that's what I wanted to talk about. Was there any charts you wanted to put up?
No, I don't really have anything. I saw you were going to almost pull up the uranium one. That's interesting because we had a situation with Cameco. They have a fire. All of Western Canada seems to be on fire, by the way. It's terrible. And they had to close Cigar Lake, which is their big mine, yet there wasn't as much of a reaction in the U as I might have hoped.
Yeah, but even Cameco, let's take a look here, didn't even move. Doesn't seem to worry
I don't know. I'm a little worried. Like, we're going to listen. The fires out there are pretty serious stuff. Yeah. I saw something that there was 6,000 lightning strike or 5,000 lightning strikes in this one period of time after the 45-degree weather. Oh wait, 45. I got to do that in Fahrenheit. What is that in Fahrenheit? Like 120 or something? Like we're not built for this. We melt up here in Canada when it gets that hot. We're not built for this.
Actually, let's put up two currencies. I want to, or at least what I wanted to just.
You haven't talked about the dollar and how it's the most important thing to watch next week.
You know what? Because we told everyone how important it was last week.
That's right. Everyone
Sometimes
knows.
We have to give a gap. Everyone knows already. But that U.S. dollar against the Japanese yen broke out to a fresh high.
That one's actually shocking to me, and I find it interesting. And I thought actually that it was a good risk-off trade. And I guess now that we're having a risk-on period, it's not surprising that the yen is going down so aggressively. But it's really one of the few currencies that's doing this badly. Like, you go look at like euro, yen, and or almost anything against the yen, and the yen's just stinking.
Yeah,
I find it fascinating. I almost think that when it comes time to bet against risk, that the yen is going to be a cheap way to play it. I don't know. That's my 2 cents.
You know what? You might be right. On the interim, I don't see much standing in the way of us, testing that kind of 114, 115 zone. But that doesn't give a lot of upside. I mean, that's sort of like the dollar index trading up toward 94. I mean, I don't know if that's a game changer if it does. But at this stage, this on a weekly chart, I think there's room for a little bit more strength in the U.S. dollar against that yen to those zones. But anyway, the trend continues. Anyway, and just a quick note on the asset that shall not be named. What I was just going to point out is that the price action still remains incredibly distributive.
Send your hate mail to Patrick at Big Picture Trading.
No, I'm observing price action, not making an opinion about Bitcoin. All I'm saying is that if the bulls want to turn this, they better start buying and showing some more positive price action, because this looks like it's being actively distributed. And if this kind of price action persists, it may weaken all the way down to 25,000 or less on the downside.
I thought what I thought was interesting, Patrick, is that if you go look at Tesla's cost of Bitcoin purchases. I think it's, I don't know the numbers. Someone will tell me the numbers. I think it's 34,600 or something like that. So regardless of what it is, it was very interesting that this quarter end, it closed at, drum roll please, 34,600. I feel like that old man in that Disney movie Up when he says, coincidence? I think not.
Yelling at clouds, Kevin Muir. All right, buddy.
Me and the old man from Up. That's what it is.
There you go. All right, that's enough for talking charts. Let's go on.
Okay, Patrick, time for This Week in Trading History, and you have a good one for us. A little bit of math.
That's right. Yeah, well, you know what? It was on July 1st of 1941 when Myron Scholes was born. So that's from the Black-Scholes option pricing model background. But he's a Canadian boy.
I didn't realize this. You told me earlier, and I was shocked.
Yeah, he was born in Timmins, Ontario, the same place where, you know who?
Well, who?
Shania Twain.
Shania
Twain.
Wow.
Absolutely. Shania Twain was born in Timmins, Ontario.
I hear Shania Twain is unbelievable Black-Scholes. She's a great option trader. She does it in her head.
Yeah, absolutely, she does. That's a lot of people from Timmins have that gift. But nonetheless, his family moved there during the Great Depression. But in 1951, his family moved to Hamilton, Ontario.
Oh, listen, he just went from one awesome place to another.
There you go.
For people that don't know Hamilton.
Anyway, we had to mention he's Canadian.
We're gonna piss off all the people from
Anyway,
Hamilton.
so nonetheless, eventually he became American. But anyway, let's
like all great people that go on to do stuff, they leave Canada. To go to the States.
And so anyway, but I wanted to just talk a little bit about
that's why we're still here.
The birth of the Black-Scholes option pricing model. So the equation and model are named after economists Fisher Black and Myron Scholes, as well Robert C. Merton, who wrote the first academic paper on the subject, is sometimes also credited. So this Black-Scholes Merton model is the mathematical model for the dynamics of a financial market containing derivative investment instruments. And from the partial differential equation in the model, known as the Black-Scholes equation, one can deduce the Black-Scholes formula, which it gives the theoretical estimate of a price of a European-style option and shows how the option has a unique price given the risk of the security and its expected return, or often used the neutral rate, the risk neutral rate. And so the key idea behind the model is to hedge the option by buying or selling the underlying asset in just the right way, and as a consequence, eliminate risk. This type of hedging is called the continuously revised delta hedging, and is the basis of the more complicated hedging strategies that we often talk about on the show, that a lot of our kind of gamma people come on and talk about these things. But nonetheless, the publishing of the Black-Scholes model in the spring of 1973 roughly coincides with the start of the options trading in the newly opened Chicago Board of Options Exchange, which opened that year as well. And two events which continued to reinforce one another's importance in the years that followed. And all the options trading today we do is, they did a lot of the pioneering of what we do today, right? And but what's interesting is a lot of people think that options were created back then, but just a little bit of a history. Options trading and the mathematically modeling option prices are much older than that. Like there are documented cases going back to ancient Greece of the use of options, and as well, like for instance, there were option-like instruments also traded in the 17th century to trade the Dutch tulip bubble. And there were the first organized options markets were set up in late 17th century in London, trading both puts and calls, and the latter called refusals, and where you could refuse the contract. And so in the U.S., options trading, though unstandardized and therefore very illiquid, dated back into the second half of the 19th century. And that book we talked about, Reminiscences of a Stock Operator, that we often do, like Larry Livingston or Jesse Livermore, as we know him, did actually talk about call options, these unstandardized ones that he would build into these. So options existed for a long time. What these models did was create that mathematical model for actually how to price them and how to manage the risk if you're like a dealer, and allowed the standardization of these options, right? And nonetheless, Fisher Black's work contributed to the introduction of options on futures in the early 1980s. So his models created options on T-bonds, S&P 500 futures, and gold. And in 1997, 24 years after that Black-Scholes model was first published, Myron Scholes and Merton were both awarded the Nobel Prize in economics for the new method to determine the value of derivatives. So a lot of history in that, and that was what I wanted to talk about today, Kev.
Well, that's awesome. I think we should go back to calling them refusals. I'm going to bring it back. I'm trading some refusals.
I like it, actually. It's not bad. I'm not going to push back. It's snappy. All right.
Okay, skin in the game.
Let's move on.
And I lost another one.
You did.
Like I'm probably down now.
Yeah.
And I got cute.
Well, no. You listen, but you know what? What I love about the way we do this is that the person who makes the bet offers the other person, and we almost always fall on our own swords.
Yes.
We don't. The other person doesn't have to try. It's like by actually being able to make the bet, you almost by default win, because the other person, like you got to use the Costanza method.
Wow.
Just whatever you intuitively want to do, just pick the opposite, and it might actually work.
It's true. There is an element of that. One of our subscribers, I'm sorry I don't know who it was because my Twitter gets overwhelmed, but he shrewdly pointed out that I had done the perfect hedge, because I was either going to lose the beer, but I was going to make on my long position.
There you
right?
go.
Because
that is always the safe thing to do.
That is right, because I was bullish oil. I'm long all sorts of oil and gasoline and blah blah blah.
Except for your energy stocks, which are down.
I actually, you know what? I pitched my energy stocks.
Now, in full disclosure to our listeners,
no, but I did. You can go look at the tape or whatever. I wish I hadn't, because I pitched too many things into the lows when we had the Fed kind of switch. I pitched a lot of things. And the one thing I said I would not be touching was any of my energy futures. I did not touch a single one, and I love them all. They're like my second children at this point. I'm not getting rid of them. Second, actually, fourth children or whatever. But anyways, regardless,
you know what? Look at you. You're demonstrating to everyone how to be a disciplined trader. Where if a trade's not working, you're willing to pitch it. But then you're like, this is like my child. I'm not going to ever let it go. I'm going to go down with the ship.
Said this.
Like the
I
Titanic.
Only have one.
You know what?
I only have one diamond hand trade. And I do have a diamond hand.
Your
trade.
break-evens are getting your face ripped off.
Don't even think about them. Don't even have to talk about them. Those are on, and I don't care. I will go down with the ship. I will just be long those things, And you
poor thing.
And I'll be like,
at some point, I'm going to take the other side of that trade.
That's fine.
Me and Lacey.
You and Lacey. Okay. Well, don't talk too much about Lacey because he's coming up.
All right. So
listen. This weekend's skin game. Let me tell people. Oh, let's tell the bet.
Well, first of all, the bet was over under on crude oil at 75, but to be honest, I picked the right level because it really was close.
Yes, it was. You're absolutely
right. And so, like I priced the level pretty accurately.
It was 75.21. It was $75 you tangled out there. I said no.
And
way.
you know what?
You're
what did
high.
I win? A really nice, crisp $1 bill.
Those hurt almost more. Like at least when I get beer, like there's going to be beer drunk.
You're sharing, and there's some payoff on the other end who drinks the beer with you.
I have to pull that out of my wallet and give it to you. It's bad.
Well, I can't wait.
Okay.
I can't wait.
So let me tell people about the game. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by next episode, and the currency for the wagers is as follows. A Duke and Duke, which is what I just lost, which is a crisp $1 American bill. A la Duke and Duke. It's been a long time since I've actually watched that movie. How about you?
I saw it a year or two ago.
Really? I feel like I should get take my kids and make them watch it with me. Like, just they always get mad at like the crappy effects and everything like that, and there's no effects there. So they won't be able to complain, and they'll be just like it'll be awesome.
Anyway, go on.
The pint of beer, a burger bet, a pitcher, a case of beer, which is 2.4 known up here in Canada, a bottle of wine with a $100 limit, no boxes because Patrick is saying I don't want any more boxes, and boxes of wine, and then the big Kahuna, the steak dinner, which I owe you.
There's
still.
another big Kahuna. Yeah.
Well, I still owe you a steak dinner. And listen, we're allowed.
You actually owed me 2 steak dinners, which you volunteered to give to.
Oh,
Lena.
that's right. I got you hooped on that.
So
one.
now I have. Now
I gave it away. I put you in a bad spot there. I did.
That's okay. I hope Lena enjoys it.
Yeah. So listen, I think we're allowed to actually meet now.
Yeah.
So I think we got to do this. So you're in your 2-week quarantine. Once that's over,
I'm pretty much done it.
Okay. Once that's over, I'm coming over. Maybe
Nice.
Next weekend. We'll figure something out. I'm going to bring the Wagyus or whatever it is that you want me to buy. And you're going to grill me up some Wagyus, right?
Yep, you betcha, man.
And Lena, too. Like, Lena's going to get a Wagyu. I don't know if I've ever had one because I'm not a douchebag that orders these things.
All right. Yeah. There you go.
The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. Okay.
There you go.
So you have come up with something for me this week.
Yeah, you know what? I wanted to spur your little emotions a little bit for something that you have a clear bias for. Let's do the U.S. dollar against the Japanese yen. Literally over under 111 right here.
Well, that's a tough one. That's a good one. You definitely picked something that's over under 111 closing next week.
Closing next week.
That's a tough one. Good call, man. That's a bugger.
I'm going to let you fall on your own sword because I'll take the other side.
Oh, man. You bugger. I got to go down, which is a yen up, right? Like,
yeah.
I want to go.
No, wait, sorry. No. This is the U.S. dollar yen. So if you're going down, that's the U.S. dollar down.
Yen up.
Up.
Yeah, that's what I mean. Like, I want yen strength. Okay.
You're taking yen. So
we're using 111. We're using 111 on spot.
I'm over, and you're under on the U.S. dollar yen.
And listen, we have to make a time because it trades all the time, and the close in there is not quite.
No, it's always
4 p.m.
the 4 p.m.
Okay,
4
p.m.
p.m. level when we're basically analyze the market.
4 p.m. Friday. I'm taking lower on 111 even.
Yeah,
I like. At least you didn't try to, take an extra.
So
point
where do you want to start?
Time.
Where do you want to start the bet?
Let's just get some more pitchers going. I want to do a lot of pitchers because listen.
All right.
The piss up's looking more and more likely for the fall. Right,
yeah.
the piss up's
a Toronto piss up.
Or late fall, early winter.
Well, I'm gonna probably end up inviting our European guests or our listeners to a Lisbon piss up in
you're just going,
in
you're
September.
Like this traveling
and then,
guru that goes around.
But we'll probably maybe October we can do a Toronto piss up.
I'm hoping October, November, somewhere around
after
there.
the moose hunt.
After the moose, and you guys think we're kidding. But honest to God, when Patrick and I were going through the time, he's like, well, I got my moose hunt. And I'm like, what? So we're not.
Anyway.
That is no joke. Like, that is no joke.
It's the way we roll here up in
Well,
up
that's
north.
how you roll. A lot of us don't like going and killing those wonderful creatures, but you eat them, right?
Yeah.
Like,
it's not for sport.
Like, you must have, when you haul one of those out, it must be hard. Like, 'cause they weigh 1,000 pounds.
Like you tie it to the back of the Hummer and you haul it out. Anyway, so let's get on with the show. Like, so we're doing a pitcher of beer.
Pitcher beer, you're on.
All right, perfect. All right, let's go. Let's move on. No stupid questions. This is the part where we get Lena on.
Hi.
Hello.
I was just
Lena.
laughing at the whole moose hunt thing, and I
Yeah, I know. Well, it's
was like,
funny
oh, he's
'cause
going
Patrick-
squirrel hunting. He's not going moose hunting.
That is funny. It's true. He tells,
But this year,
he tells us
we're
it's-
using crossbows though.
Really?
So like this is
serious.
now a real sport.
So you got to be way closer.
Yeah.
I think you should get naked and just one-on-one with the moose, and if you kill it, I'm good with it.
All right.
No, honestly, like, I figure that's true nature. Like, if you're one-on-one, you've
But
made
why
your
does
own
he have
tool.
to be naked?
Because he's got to be, like, fully.
Because
like,
if I had
nature.
jeans on, there would be too much of an edge for the freaking moose, right? Jesus Christ. All right, so let's go no stupid questions. Lena,
All
what do we
right,
have
so
in store
first
here?
question. Do options farther from expiration require more underlying to be held by market makers to hedge their exposure to delta? I.e., are they opening large positions in the underlying when the option is written and gradually closing the underlying as they collect decay?
Okay, so Kev, you correct me where I'm if I say anything off the thing. But I mean, a lot of times, what's known as that Vanna effect is because as volatility is contracting on out of the money options, the thing is that it's all about what strike it is at. Because at the money options, even if that curve is shrinking or theta is decaying, the delta stays very close to 50. On at the money. It's really the out of the money options that dynamically change in their pricing, whether out of the money or deep in the money. And so to broadly say options with a farther out maturity is incorrect because it's not giving enough information if you were talking specifically about a strike. And so it's this question, it's basically the delta is the delta. And you are looking at the relationship of that delta on the underlying exposure. That doesn't change. If the delta is 50 cents on a 1 month or a 6 month, it's the same amount of the underlying that's needed to hedge it. But the gamma is much greater on the shorter dated option, which means that dealers are going to have to be buying more or a lot more or selling a lot more as a small incremental change is occurring, the shorter it's in duration. Is there something I said wrong?
No, I think you got it. You're absolutely correct, though, that the delta will vary depending on whether it's in or out of the money, whether it's put or call, and in terms of the short-dated versus long-dated, how that relationship changes.
It's more complex than the question is the way the question is asked.
So the answer is there is no actual answer to that question, and then hopefully by understanding that.
No, there isn't one. They don't require more underlying.
They might.
Like if you have a 50, if it's a 50-cent delta and it's a 1 month and it's a 50-cent delta 6 month, they're not having to require more underlying.
The question, though, Patrick, is like how do you determine that delta? Is that delta going to be higher or lower depending on whether it's longer dated?
No,
or
but
not?
as it changes over time, then the rate will change. But what the question was, does they have to hold more underlying? And the answer is no, they don't. The amount that they have to buy or sell may change.
No, but the delta will be different depending.
Okay, we're
Should
confusing
we
everyone.
Let's just answer this question next week.
No, we got it. Patrick was basically right now. He's making it more confusing than he was. The reality is that it is complicated and it depends on the strike and the type of option and when you're comparing the different terms. Okay.
Yeah.
So moving on, second question.
Yep.
Hi, Lena, Kevin, and Patrick. I've listened to nearly all your shows. Keep up the good work. It's great entertainment. At Patrick Ceresna, however, you really fucked up on your Habs comment. Calling the Canadians the worst possible Canadian team has to be a low point for you on this podcast.
I agree. Patrick.
Okay, stop. I am a dick. But one has to understand the context of my comment, because my brother-in-law happens to be the greatest Habs fan possible, and me and him have like one of the greatest rivalries on this. And
it's
this is incredibly painful. It's painful for me, and I had to take. You know what? There is a bias behind this, and I apologize if anyone else is offended, but I have to take my position, and that's it is. I'll stand by this because of the circumstances from which I'm in. Anyway,
well, I respect the fact that you're hanging tough with your terrible position. But it's a terrible position, and in the Habs are Canadians team, Canada's team, and go Habs, go.
Anyway, I don't want to reinforce your prejudice against Montreal fans, so I'll give you a pass. My question's for you guys. As you mentioned previously, the pace of gains in the S&P 500 has slowed down over the last few months. Given the current trading range, 4,100 to 4,400, would it make sense to roll up a straddle entered at a strike price of 385? Also, what are the main advantages or disadvantages of rolling a straddle? FYI, the expiry of the straddle is January 2022. Future vol for January 22 is at 23, and spot vol is at 17.88.
It sounds like a question you got in grade 12.
Yeah,
if train A is going 60 kilometers east. Good luck, Patrick. Knock him down.
I think you have to go back to why you own a straddle at all. And straddles are long vol, long gamma on wings, anticipating or hedging large moves in the market that can come about. And so the thing is that we have been in a trade range. Now, is that straddle in your portfolio to hedge your overall portfolio, or is it a trading position betting that volatility will increase and that there will be a big move? Typically, if you're down at the 385 strike, there's a benefit to becoming at the money if you believe, for instance, that the put has, or the left tail of the straddle will actually have the big move. Because if you're down at the 385 strike, it's going to take still like almost a 10% move in the index in order for you to start building any intrinsic value on the put side of it. And so the only rationale behind rolling the straddle is if you believe that the left tail risk is real and that volatility will increase. And why are you in the straddle in the first place? That's my little 2 cents about that. You have anything to add to that?
All I can think about is this reminds me of like if you have 12 chocolate bars and then you eat 25 chocolate bars, what do you have? And the answer is diabetes. That's all I can think about. Next question.
All right. So next question. Why do long rates fall when the Fed warns about potential rising rates? Does the Fed disagree with deflationists about the end of the reflation trade? Is China or real estate the real driver of commodity prices and interest rates rather than the Fed?
These are some terrific questions. I'm going to jump in here, Patrick.
Yeah, you.
Okay, this one's mine. Okay, why do long rates fall when the Fed warns about potential rising rates? If you think about as a long-term bond investor in U.S. Treasuries, let's just take default off the table because realistically the Fed and the government can print its own currency, so there should be no risk of default. They can always print more currency, so that's not an issue. So what is your risk as a long-term bond investor? It is inflation. The worst thing that can happen is for inflation to be created because your future dollars are going to be worth less in the future. So therefore, as a long bond investor, what you want is as little inflation as possible. And in fact, the reason that these bond bulls are all kind of a grumpy bunch and always want the world to end is because deflation actually helps them because they have more future dollars that'll be worth more as deflation goes. So the question is, why do long rates fall when the Fed warns about potential rising rates? It's because the Fed has shown that they are less willing to tolerate inflation over the long run. So your investment will be worth more. And that was why, ironically, even though the Fed got more hawkish last week, or maybe it was 2 weeks ago, The reality was that the long bond rose in price, fell in yield, because the long bond investors felt more comfortable that the Fed wasn't going to let inflation get out of control. So that's it. Okay, now let's go to the next question. Does the Fed disagree with deflationists about the end of the reflation trade? So I guess the Fed doesn't really disagree or agree with anyone, but I do think that the Fed is looking at things much differently than the market is looking at it. So the market is looking at it and saying, I think that the Fed is out of control and therefore they're going to have an inflation spike and therefore the Fed's going to have to tighten quicker in the future than right now. And the longer they wait, the worse it'll be in the future. And the Fed is saying, I don't think that that's going to happen, and even if it happens, we can control it. So it's much different, and I think it's more complicated than the Fed disagreeing with the market. But I will say this. The Fed is more confident about their ability to slow things down than the market is. And the market is concerned that the longer that the Fed lets it go, the worse that the ultimate response will be. So that's like, I would sum that up that way. Okay, next thing. Is China or real estate the real driver of commodity prices and interest rates rather than the Fed? This is a terrific question because there are two elements to commodity prices going up. One is financial speculation, meaning when we go buy crude oil or we buy copper because we think that we want to own real assets. The other thing is when the actual real economy uses those assets. And there's no doubt in my mind that financial speculation drove commodity prices over the last 3 to 6 months, much more so than the underlying commodity. And all you had to do is go look at the commitment of traders reports in terms of how many hedge funds and other speculators were long commodities. Just go look at what everyone's predicting for copper or anything like that. So there's a huge factor in terms of financial speculation. Now, having said that, I think that got all completely cleaned out, or not completely, but very much cleaned out. It was rinsed. All those speculators puked their positions at the Fed's change, and I think that it's trading more based upon fundamentals. The final question, the part of that question is China affecting commodities? The one thing to think about is that increasingly, China is not the driver of commodity prices, especially when you're talking about things like copper. Copper is getting pushed around by the electrification, and that's happening more in the U.S. And we're seeing increasingly that it used to be kind of a decade ago that China was all that mattered in terms of setting commodity prices. Increasingly, it's returning to a much more balanced environment, and China is becoming less dominant in terms of setting commodity prices. And increasingly, the U.S. and all of the kind of green electrification and all that stuff is having more and more of an effect. So I hope that answered your questions.
All right. So, one more here, Kev.
Okay.
Lena.
So I would love to hear Patrick's view on this Q&A. So there's a link to a Lacey Hunt interview. I will include it in the video description and link it in the email. And where did you buy your Lacey Hunt poster? I need a full-size cardboard cutout for my room. He's a legend.
So,
first of all, let me start off here, Kevin, because you can talk about your
poster,
your little thing there. Yeah, posters in a moment. But first off, I did have a chance to kind of have a quick look at the video, and you know what? I do always appreciate about every 6 months to get my regular dose of the law of diminishing returns and the velocity of money. It's an important anchor for a proper deflationist. Anyway, but it was good. I liked the video, but it's basically Lacey Hunt. It's a stance that's been very similar for many years.
Decades.
even decades. Yeah, it's a core view on the markets, and it really, like, if you go back and listen to any of his other interviews, he hasn't really. I mean, he did add color to the idea of central bank digital currencies, or how monetary policy, or how changes in Congress could change the mandate of the Fed, and there's different things that he highlights, but more or less his core understanding of the economics has pretty much exactly the way it's always been.
Now let's get on to the real important question: the Lacey Hunt posters.
Where the poster. I did call Mrs. Hunt, and she did send me the pictures, and which you then
took a snapshot of. And
yeah,
it is from the 70s. It is from the 70s, and I didn't know that Lacey was part of the Hardy Boys crew. But he really was. He was part of the Hardy Boys crew, and he was also a teen heartthrob that had,
He was.
He sang the Do Ron Ron and Do You Believe in Magic? Some great songs. Teen Dream.
He is a
Teen
legend.
Dream as well. And Patrick's got the pictures all over his...
But you have to have them, you can't buy them online. You have to have them printed. But Mrs. Hunt was kind enough to send me some of these pictures, which I was able to print. And but it's,
if you want to check it out, check out Patrick's Twitter feed. That's where you'll find them.
All right, Lena, where can they send their questions?
If you have any questions for Kevin and Patrick, or you have more hate comments about Patrick's comments on Habs, please send your comments and questions to
the Hab haters
questions at markethuddle.com.
All right, perfect. Oh, that's a wrap.
That's it.
Kev?
So let me do the outro. Thanks for tuning into the Market Huddle. We appreciate you spending time with us. Please give us a follow on Market Huddle on Twitter. Lena's there. She gets tired of Patrick and myself. You can listen to Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe, or smash, or do whatever you're supposed to do there. Please give us a review on iTunes. You know why. Patrick, where can they find you?
You can find me on Twitter at Patrick Ceresna, or at bigpicturetrading.com. And Kev, where can they find you on Twitter and subscribe to that amazing newsletter you have?
Again. Kevin Muir on Twitter, and you can check out my newsletter at themacrotours.com. And listen, you can never have too many friends on the bear market, bull market. We're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show. Okay, I have something I want to talk about before we start the beers.
Oh.
Can you go to the opening picture?
All right, I have to somehow go through all of.
Well, I'm just gonna paste it in.
So for those who are they don't realize this, it's or listening to this on podcast, which makes much more sense because you don't want to see pictures. But the Sounds of Men. This is a CD-ROM or CD, and it says The Sounds of Men. Every sound a man will make contains male breathe, which makes no sense. Hard hat, murder, open parentheses, sword, close parentheses. You will love to hear this album, and it's for sale for $4.99. And then Patrick made this one, and he wrote "Found in Kevin's glove box," which I think is just completely uncalled for.
I thought it was appropriate. I did find it in your glove box, and I mean, you need to be shamed.
I felt like this was just, something that you found there, and you would just keep quiet, and you brought it up in front of everybody, and now it's just embarrassing.
And look at the pictures on the cover, though. It's like the guy that's laying in the very front. That's not even his real head. It's like somebody else's face on somebody else's body.
I don't really understand the front pages, but I love the sounds.
Yeah.
It's
you just listen
60
to
minutes of.
All right, let's rate this beer.
Of men.
All right, let's rate this beer.
I'll start because I missed the last one. I like this beer.
Oh my God.
I like this beer a lot. Strangely.
Oh my God.
Like I do. I don't. Listen, it's like love. You can't really, kind of decide who you're going to fall in love with. You just fall in love with people. This beer is the same way. I don't know why I like it so much. I just love it. It's getting a 9.1.
9.1? Jeez.
Yeah, it's weird.
It's one of your highest ratings.
It's weirdly good. It's weirdly good, and I'm embarrassed that I like it. But I like it, and that's it. I'm going to stand by it. That's it. I have nothing more to say.
Lena, please bring sanity back to this
I was very
conversation.
surprised because I was I think I told you guys I was kind of dreading this beer because I was like, what is this going to taste like? But it was delicious.
Yeah.
Oh my God.
And when I was reading about the beer, it says taste fruity, rich, and banoffee. That's a banoffee pie, and I think
yeah.
That's banana cream pie, I guess.
Yeah.
Basically, it's so good. And when I read that, I was like, oh my gosh, this beer is it. Like, I would give this probably a same rating as Kevin, actually.
Oh.
What?
I would drink more of this. I would drink more of this than what we had
my
last week.
God. Okay. I will agree that this is not remotely as bad as last week's, right? And so I'm not going to score it that low, but I feel almost compelled to have to underscore this to bring balance to the universe from this absurdity I'm hearing from the two of you. No, I'm gonna give it like a 6.1.
It's because it wasn't sour.
I will never buy this beer ever again, nor will I ever drink this beer again, and I'm done with it. And
I love it.
You
It
know what?
smells
I
so
hope
good.
all of you can take as much of this and drink as much of it you want, because I ain't gonna have any of it with.
I love it. And you know what, Lena, you mentioned banoffee pies.
Yeah.
When we went as a family to Ireland and we went and stayed at Ashford Castle, we would walk into town to get the most unbelievable, like, it's literally when you walk into town, it's like you're at Downton Abbey and you're walking in like through the Grand Estate or whatever. And we would walk in to get the banoffee pies, which like me, my wife and the girls wanted
So
every
dreamy.
single. Yeah, it was pretty good.
I would get
But
fat for this pie.
But listen, I would get fat for this pie. Who knew you could put banoffee pie in a beer though? Like, genius.
They should call it banoffee pie beer instead
They
of banana
should.
bread beer.
Okay, can we please stop talking?
No,
about
they
this beer?
should. You know what? I'm gonna write them.
Please.
I'm gonna write them with our suggestions.
So good.
Okay, well, anyways, what else do we have to talk about? I don't really have like anything else. Like, I got no new shows. Oh, that's not true. New Bosch. Are you guys a Bosch fans?
I think I finished watching. How many seasons are there right now?
There's a 7 now. There's just came out the last week.
Then I only watch. I'm only halfway through like the actual series, so I'm only.
Oh,
like,
so
season
you're a
3 or
long
season
way
4.
away. So it's no big deal to you.
You know what?
We're big fans, so this has been awesome because like Bosch is.
It's
is the
good, it's
coolest.
good.
Oh, he's awesome, and I love watching LA. I love watching all the places, and
He's so
it's cool.
badass
It's cool.
in that show.
Yeah, I know he is badass. I completely agree.
Patrick doesn't know what we're talking about.
I can officially say that I will never watch TV or movies because I went in a 2-week quarantine by myself. If there was ever one window of time where I would have turned on the TV to actually watch some of this stuff, it would have been now. I maybe watched 2 episodes of Archer because I was just bored at one point. And I watched some soccer.
Oh yeah.
I watched these great soccer games,
one
but
on right now.
other than that, yeah, I'm gonna go check it out. But like, it's that. Other than that, no, I'm just not gonna watch. You guys are gonna always have this conversation without me. I know this for a fact now.
Patrick's watching something else, but we won't get into it.
Oh my God! All right. Anyway,
But, there was a comment saying, "How come we're not talking about the Miami piss out or Miami muddle?"
well, we did tweet it out, and I guess we shouldn't. And we did talk about it. I guess we didn't talk about it with Cuppy because Cuppy we were recording right before it,
Yeah.
right? And it was great to meet so many of our listeners. It was that was great. Like we had
such a great time.
what, like 50 plus people show up. It was everyone got a free Market Huddle T-shirt.
Speaking of free Market Huddle T-shirts, I haven't got mine yet.
Well, you know what? That's because I'm in quarantine and you haven't come over to bring in my steak.
You
But
can
anyway,
trade in your steak for the T-shirts.
That's right. Sounds like a
exactly.
great
But
deal.
those that don't know about the T-shirt, it has a great one-liner on it. What was the one-liner?
I don't actually know because I don't have one.
Oh my God, Lena, tell them
Don't
what
Goocher
the
it.
one-liner on the. That's right.
It was a good choice.
Don't Goocher it. It was a good choice.
It was a good choice of
But
taglines.
yeah, no, like we're gonna have to start our own merch store now because everyone's gonna want a Don't Goocher It shirt.
Yeah, well, of course, because it's Market Huddle.
Well, Patrick made a quick speech at the model? If you were
please
there,
don't.
you know what I'm talking about. There was a recording of it, and I said, no, I can't put this up there.
No, you
share
can't.
this with people who
It
aren't
was.
there.
It was. I was.
I love you.
No, but now like you're working it up.
I love you guys.
Almost.
Was it? I haven't seen it. Was it like a
I'll have
liquored
to
up
send
like?
it to you.
Oh
liquored
God!
up, yes. Well, yeah. We'll
Was
just
it?
leave there.
Was there slurring involved?
Isn't there always?
Listen, I specialize in making. I specialize in
with
making
the
a fool of myself.
Yeah, I know, but Patrick, we all love you, though. We all love you. We know your heart's always in the good spot, even when you're doing it. I don't know if anyone experienced peer pressure Pat, though. As I've explained numerous times, Pat, when he gets going, he just doesn't, like, he's binary, like he has no off switch. He just keeps going.
You'll see that at the Toronto Piss Up.
Yeah, like it's just like, like he'll be there the next day. Like it'll still be, we'll be looking for Pat and it'll be like, oh, he's still at the bar.
Well,
he's closing
It's a
it.
happy hour somewhere.
Yeah.
I am a warrior that
You
way.
are.
But
You are a machine. Like I know. Like you don't like. It's not like you handle your liquor well, but your endurance is.
I don't quit.
Your endurance is outstanding. Like it's like literally.
So it makes me a good trader. I can take a beating and still like stick
you
around.
have endurance of epic proportions.
Apparently.
In terms of how long you go.
Squirrel diet is really good for your liver.
Is it?
Oh my God.
Clearly.
Squirrel stew. Remember? I still got to find that thing with the squirrel stew. Can you imagine just eating the whole thing?
Oh my God. Let's not get into
Like
it.
that would be just terrible. Like just awful. Oh, I didn't tell you what we did. I didn't tell you about my trip.
Oh, yeah.
Oh, I'll tell you just briefly about my trip. So, first of all, we went to Quebec, La Belle Provence. That's why I'm being especially nice to the Habs fans. And we went to a place outside of Ottawa we started with. And around there is this place called a mega park. And a mega park is crazy in that it's like one of those zoos that you drive through.
Like a
So
safari,
we have one. Yeah, we have one of those here. It's called African Lion Safari, and there's all sorts of giraffes and things like that. And you just drive around and you look at the things, and it's great. But this is all Canadian stuff, like native species.
Okay.
And there's so many. Like I think they're elk, but there's some sort of deer/elk or whatever, and they'll literally stop your car, like they'll go in front of you and squeeze you into stopping. And then stick their heads in the window for carrots.
What?
Oh, it's crazy. It's just awesome. And we had just a huge blast feeding all the elk and then there's wild boars, which I've never seen before out in the wild. Patrick's probably hunted a few of them. Right? Have you ever hunted a wild boar?
No, I haven't.
Oh, you should do that because that would be pretty tasty. Big thanks to my buddy Pro Greta blog, Viral Rockets. He actually told me about it, and thank you very much. It was as much fun as you said. The kids did indeed love it. I think it's a terrific thing if you're ever got a chance, if you're ever outside of Montebello, Quebec, and you're looking for something to do, go check out the Canadian not lion safari. Oh, there's wolves, bears, and it was just like it's just a good time. So we had a lot of fun. And then we went to Mont Tremblant, and I did a little mountain biking, and it was a lot of fun. So it was good.
Wow.
That's it. It was nice to be gone. Like, listen, literally, I haven't spent a night outside of my house for the past year and 4 months or whatever, so it was really nice to sleep somewhere different.
I bet.
Yeah.
I'm looking forward to my quarantine ending.
I can imagine. You're probably going a little crazy. Doing the prison walk. Or when those animals are at the zoo and they go back and forth in a room and then you go, oh, something wrong with that lion.
What's going on?
And that's basically Lena and Patrick. We're almost there though. It's actually a shame that you guys, well, I guess neither one of you are double vaxxed yet. So you got to go get your double vax. Have you got your appointment yet?
Yeah, no, I'm going on Monday.
Wow.
Oh, good.
I
And
can't book mine yet because I was.
You're too young.
Well, no, because
that's not true.
I was vaxxed outside of Ontario, so they're giving me a bit of a flack right now.
Oh. So just don't tell them and just do a second
but
one.
you know what? What's the pisser is that the first shot that I got. I don't know if you got it as well, but I got the AstraZeneca Covishield version, which is the one that was made in India. And there's a bunch of countries not recognizing it. And so there's there's a suggestion that if you go and travel with a double vax, because one of them is the Covishield, that they won't consider you double vax.
Does AstraZeneca make two?
Well, there's the one that was made in Europe, and then the one that was made in India.
How do I even figure that out? Which one I got?
Yeah, well, you got it pretty much the same time as I did. I bet you got the same one.
Oh, I'm figuring.
So I was gonna go for my second AstraZeneca, and then I said after this, I'm like, well, if they're gonna treat me like if I've like that first shot didn't count, then I might as well get a Pfizer as my second shot, and then I can get double Pfizer.
Yeah, you should.
That could be a pincushion to all
listen,
this.
and listen. I'm not upset that they used AstraZeneca because I think it still saved lives, but I have a feeling that it's not as good in terms of I just got this
Oh, you're just I don't even buy that shit. I'm just pissed off that the fact that I have to do this all over again. Almost, it's it's anyway. Whatever.
Doesn't matter. So both of you. So you've got yours. Mine.
I'm going Monday for a Pfizer shot. Yeah.
Okay. And Lena's in trouble. Just don't tell them you even have your. Just say it's your first.
I couldn't schedule my second shot unless I told them where I got my first one.
Oh, so actually, you know what? If you didn't tell them, you got to have. Oh yeah, you got problems.
Because they have to have it on record if I wanted to travel later on. So.
Oh yeah,
I'm a law-abiding
Listen,
citizen,
we're all gonna have 3 by the time it's over. We're gonna have a bunch of them. It wouldn't surprise me at all.
Why not just get a cocktail of all of them, right? Just pin me with all of them, and
just
you know what?
Patrick drinks. Sure, bring it on.
Vax cocktail.
Yeah, the Vax cocktail. That's Patrick. Yeah.
I'm not gonna have. I'm not gonna have any more kids, and I'm not gonna live forever. Whatever. You know what? Pin me as many times as you want, or jab me as many times as you want, and if there's a side effect, we'll find out. And who wants to live forever?
Who does? It's
I don't.
Boring.
Yeah,
it's
boring.
Think about those elves in Lord of the Rings.
Yeah, what boring lives they live.
No, honestly.
Yeah, all right, I'm done.
Okay. Have a good weekend.
Anything else you guys want to talk about?
No, I got nothing else.
All right.
Have a great weekend, everyone.
Right.
Thanks for tuning in. See you next week.
All right. Thanks, everyone. Cheers.